a while. So, I mean, 2 weeks was not a lot, but it felt like a lot. Anyways, I have this report right here. So this is why, well, I mean, based off my global macro analysis, right? What I have right here is a pooled summary of like the most recent on Friday's trading day, all the ETFs and their performance, right? So the ETFs have one USA, global ETFs, bond ETFs, commodities ETFs, volatility ETFs, and currencies. If I were to zoom out and tell you just to look at it visually, you could tell like all the green is down there in the volatility segment. But if you look at the USA segment, I'm looking at this right here. So gold miners. They performed very well in the last 3 months, in the last quarter. So about 9%. I mean, it makes sense in this market volatility. Everything else, right? In the last quarter, you got S&P 500 down, it says right here 9%, right? Mid-market down 11 to 12%. Small caps down 15%. Crazy stuff. So I have a gold watch list. These are the ticker symbols that I'm currently super bullish on in my portfolio. HTS. So these are the symbols that I really like in gold right now. Right? Especially KL. KL's been performing in the last 2 weeks very well. But these are my gold plays. Let me see who's online right now. Well, before we start, anything new with you, JC?
Nothing pretty much, just following the call, the short call, and now we got the break below the 50, complete break below the 50.
Yeah.
Complete, so I wouldn't be surprised if in the next couple of weeks go down to 200 and made real fast.
Mm-hmm.
Like another 200-300 points.
Right. I'm sure.
And then once we get to the 200 remain, it's going to be, then we're going to see how it develops from there. But that's my target.
Yeah. Hey, good morning, Darsh. I don't think we ever met before, but joining online today instead of in person. So, Darsh, have we met in person before? I'm not sure if it's your first time or second time, but welcome. We're just kind of getting started over here. I normally let maybe like about 5 people before I get started, and then 10 people to really get started, depending on the crowd. I don't expect much. It's cold. Holidays are around the corner. And markets suck right now. Hey, what's up, Maureen?
Hey,
how's it going? Good. We're just kind of getting started right now. I was just sharing with JC, these are my, what I have right here are my top gold picks that I think are relatively going to perform in a downturn market environment. I can't quite confirm a downturn yet, though I feel like one is in the horizon.
Oh, yeah.
I think it's a little too bold to for someone my age to say, hey, it's a downturn. So I'm just going to react to what I see. And this is all from pure reaction. We do have I don't want to go too deep yet. We do have, a quick snapshot of Friday's performance, right? And if you look at it, this is USA. I was telling JC. Down here's volatility. So if you're long volatility, you'd probably be in the green. But I'm mainly looking at gold miners right now. So gold miners in the last quarter has been performing 9%. Oh yeah. Yeah, those are gold miners right there. So yeah, that's what I'm seeing. S&P 500, if you look at it, this is what it looks like right now. Looks like we might go for a breakdown. Volatility didn't spike at all that much. If you look at volatility over here.
I noticed that the VIX has not skyrocketed.
Yeah, so it's not a capitulation event yet, right? So it's only at 21. Typically, when we see VIX at 21.45 or whatever I have right here. Okay. Yeah, so typically I want to see a VIX above 30. That's when I feel like buy a dip is a good idea, but I haven't seen a VIX at 30 yet, so I don't think buy a dip is kind of safe yet. So it's just mostly like short-term trading, or I just can't tell direction right now. All I can tell you is going sideways. But from the last market activity on Friday, it looks like we might break down and go a little bit further. So my positions into the swing trade or whatever it is, I'm looking at gold and gold miners.
In the form of what?
ETF
or the
individual stock? Yeah, I was showing the portfolio that I constructed.
GDX or GDXJ?
So that's an ETF, but if you want direct exposure, these are the ones I'm looking at. Because I feel like AAM is probably not my number one or number two. GG is also my number one or number two. KL is also a good one as well. So I think in a bear market scenario, when institutions, when they realize like, you know, we're probably going to print more money, hey Chris, we're probably going to print more money, I think this will be the institutional pick. Anico Eagle Mines Limited.
Well, it's a safe haven usually too.
Yeah, yeah. So the concept or the framework I have in my head right now is that gold is the macroeconomic chess pieces are in play for gold, right? Because they ultimately might need to print more money or raise interest rates. They have to do either one, central banks, and it kind of rubs off on everything else. So I think gold is just going to benefit no matter what. If they raise interest rates, then markets go into panic mode. It goes into panic mode, then I think we need to print more money. That seems to be what they've been doing all along. And so AEM, for its size, is considered a growth company. If you look at its sales are still going up, right? And it's barely positive in EPS, but that's not bad. So I like this one moving into a potential bear market. Do you guys have any like comments or opinion on gold? Like, is it new to you guys, or it's new to me? It's not typical for, like millennials just don't look at gold. They look at Bitcoin, but that doesn't even make sense, right?
Bitcoin's too risky.
Yeah, exactly. So I look at gold from there's many layers that I look at it from. Well, actually no, I'm thinking of Bitcoin, but I look at gold in terms of like a sovereign perspective and invest in a money manager perspective. Those are the two main perspectives I look at. Sovereign in a sense where in the last few discussions we brought up, I don't know if you were here, but it was the one about China, how China locked up their economy and started printing money like crazy. Were you there for this one?
Yeah.
Yeah. So we showed that chart how GDP was growing and then the money supply was growing. For the US, every time the money supply would grow, GDP would grow more than that. But China in the most recent decade, their GDP was growing, but not as much as the money printed. So they were really manipulating their economy. So it's kind of...
For me, just from studying gold for a long time, I think what gold is going to do is going to be according to we got inflation or deflation, right? So basically, as far as what the Fed is doing, that affects gold slightly. But the biggest effect of gold is going to be if we start having inflation over 2%, 2.5%, 3%, gold's going to start kicking higher. And that's going to force the Feds to start raising rates to control inflation, which is going to even skyrocket gold higher.
Yeah.
Now, if we don't get that inflation, we start getting a deflation like we did in 2008, gold is going to go down with the market and everything else.
Right.
So gold is really tied to inflation and deflation more than anything.
Yeah.
What about silver?
Same thing, like gold. They're both going to.
Yeah, I think they
With inflation.
perform relatively closely the same. But I'm seeing activity in the most recent near term in gold right here. So palladium, I don't know much about palladium, but it's been like going up like crazy.
Yeah, always in gold.
Yeah.
Is that, palladium is in electronics?
That I'm
Is
not
that
sure.
for electronics?
I'm not an expert on all metals, but I mean I personally like to just listen to money managers and what how they're viewing the world, what opportunities they're seeing, and so a lot of them right now see gold as an opportunity. Now I have stock picks in my mind, right, for like a dip buying opportunity. Like I know which ones I'm gonna run to when if markets really do start turning around, but I wanna take it easy right now. I don't wanna right. I want to go for the crazy. Like I would go for Microsoft and all that. I would add in more, but it's just so uncertain right now. So I feel more comfortable with gold. Hey, welcome. How's it going?
This is the meetup?
Yeah, this is the investment club meetup. Nice to meet you. I'm Kay.
Hi, Kay.
Hey.
Christine.
Hey. Yeah. So feel free to sit anywhere. I think were you the one who messaged me if this is like more of a basic kind of.
Yeah.
Okay. Well, today we're gonna review the central bank financial stability report. I know I sent it to you. I don't know if you reviewed it yet, but I went kind
I
of.
didn't read that thing.
Okay, no problem.
That was too long. It's more.
I know.
than need to know.
Yeah. So that's okay. So I love digging into this.
Yeah.
Hey, welcome. So normally this financial stability report to me it was like 40 pages.
Yeah.
If you guys read the In Gold We Trust report, that thing was 250 pages.
Cool.
So I read that one as well. Hey Bernard. Morning guys. So I know there's some basic or beginners in here maybe.
Yes.
Okay. So I gotta go a little bit more easy. That's okay. I'm kind of rusty. It's been 2 weeks. I took 2 weeks off, partly because of holidays, getting a little sick, but not too sick. And it was my birthday as well, and my wife's
Happy
birthday.
birthday.
Hey, thank you guys.
You're
So
22?
now I'm 28 now. 22. Yeah, so I mean, one day, so it felt weird. I was telling JC just now, like, it felt so weird not running these meetups. Like, I felt like I had so much time. And what I did was pretty much just read and cold call a lot. So I've been ramping up my cold calls and working on my CRM. So I know SK. So this is my personal Salesforce. I own a personal Salesforce subscription just so I could source deals and be more sophisticated with building my pipeline. And this is for real estate, but also for business brokerage.
Oh, okay.
So if you look at right here, these are
Right.
my real estate deals I have in the pipeline, and over here are my business brokerage deals that I have in the
Got it.
pipeline. So right now it's an auto shop, and another one's a manufacturer or printing shop. So those are two that I'm trying to work on selling. But the reason why I want to bring this up, because there's been questions about how do you deal source, like what's it like? Because I do it, like, I've been doing it for a while now, and it's the same concept as how do you find trading opportunities.
Sure.
You get what I'm saying? Like,
Yeah.
like you constantly have to keep finding the next investment. Same thing with you constantly have to keep finding the next deal. So the way I view sourcing deals is exactly the same as how do you find trading opportunities. So in sourcing deals, you would have to go through something like this, like a lead database and just cold call everyone, or a property database and cold call everyone for that specific deal. In trading, however, you go through a screener and you screen a specific setup, right, based off your analysis. So I get the thrill out of both. One is like, I don't know you, but I want to give you a call and see if we do business together. Maybe I can help you out, consult you on your business. Kind of geeky, but like I said, the 2 weeks that I had off, I felt lost, or I felt like something was missing. So glad to be back.
When was the last meetup? Because
2 weeks ago.
2 weeks ago, right?
So last week was off. Because I had a cold, I'll tell you why maybe. And then the week before that was like Thanksgiving week,
Right.
if I recall.
Yeah.
So I took that one off.
So,
Yeah, so it's been like 2 weeks off. So yeah, I missed you guys. So I was at my sister-in-law's house, and they buy such. She has a decently sized home, but like they don't warm it up or anything. It's just like. Sometimes you
You
can.
gotta pay for the mortgage.
Yeah, exactly. Like, okay, like
trade-offs.
there's like Christmas lights outside, but I'm freezing. It's an ice box on the inside. It looks warm on the inside, friendly, but on the inside it was just And then so I woke up that morning. I'm like, oh, I think I got a sore throat. I can't teach today. So, okay. Anyways, hey Aaron, nice to see you again, man. Let's jump into it. So today, guys, coming back from it. The 2 weeks that I was gone, the central bank released a major economic report, the Financial Stability Report, and it really gave their insight into how they view the economy and what they view are vulnerabilities or whatever. And so I think this one is an important one to start talking about, just because if you could, as an investor, align yourself to think as a central bank, that's like the highest level you can think, and critically. Or perform analytics. So yeah, the central banks. Yeah, so for the beginners in here, you kind of have to understand the pieces, all the pieces of the puzzle, right? Like they basically print money, or they manipulate the supply of money. They have to. And the easiest way to understand this in the simplest form is a Monopoly board. Play a game Monopoly. And if you understand that game well enough, every round you go, you get $2,000 Monopoly dollars. Now imagine every round you go, I, as a central bank, say you get 4,000, 6,000, 8,000, 10,000. And so your players around you, you will start bidding asset prices up. So that's why we listen to central banks. And so in the most recent report, I think they did a phenomenal job just analyzing the many corners of, where are the major risks. And it really came down to just 4 segments, okay? And I'll show you the table of contents right here. So the 4 segments, let me know if it's clear too. So the first part was the purpose. They just talk about, why are they doing this? They basically have to be extremely transparent. I know we had a discussion in the chat where, some people in the chat believe that maybe the banking system's not that secure. But based off their analysis, I think they have to be very transparent and honest and do, great due diligence research. I think it's quite accurate in my opinion, but that's up to anyone to judge. And then they have the framework. The framework basically tells you how they think about the world. So if you were to read this, maybe you don't have to read all 40 pages like I did. You could just probably read their framework, not the overview, and the near-term risks to the financial system. I can send this to you guys. The near-term risk is basically what we've been talking about for the past few weeks. Near-term risk is trade wars or increasing trade wars. Believe it or not, trade wars have been happening for like 10 plus years, right? It's only when Donald Trump got elected that topic got hotter.
Not to this extent though, where they actually impose the tariffs.
Yeah. Oh, right. Yeah. So you're right. Yeah. So trade wars, and they also talk about economic spillovers from Europe and also emerging markets like China. So the second biggest economy in the world, China, right? They're in a bear market right now. They're down like 20, 25%, whatever. So they fear that, they incorporate that into their analysis. So that's cool that we talk about it here because we talk like a central bank, hopefully. Anyways, they divide it into 4 pieces. Asset valuation pressures, that's their number 1. They themselves feel that asset prices or stock prices are a little too high, right? And if you follow this closely, or central banks closely, or at least a lot of money managers, the way they comment about the central banks is that they've been printing money recklessly. It seems like every opportunity the S&P 500 gets a chance to dip, they come in and save the day by printing more money. So we're really talking at a very broad macro level. This doesn't apply so much to like helping you as an individual trader, right? Like if you were a trade like Bao, he's more of a short-term whatever happens on the spot trader, right? Or a short bias opportunistic trader. This is just more like understanding what's going on in the world and picking investments that you could go a little bit longer. So, hey Michelle, it's been a while. Yeah, so I primarily right now I'm looking at gold. There's a lot of tech stocks that I really want to buy. It's just this environment's too scary for me to hold confidently, especially in options position. So I'm looking at mostly gold and gold miner. And there's great logic as to why gold makes sense. Because it's the one thing you can't print. Say again?
Yeah, but gold technically behaved horribly.
Like techno charts?
Yes.
Yeah, it's behaving horribly.
It tries to come up and it always fails.
Yeah.
Last minute
Yeah.
years.
I mean considering it had a crazy awesome run in 2000, right?
2012, yeah.
Let me pull up the metals and then show you the bigger chart. So this is gold. We'll pull up the monthly chart. You see from 2000, when they started printing money, maybe in 2008, they printed money, broke out, and went even higher. So yes, it's been performing poorly since 2012, but I think it's it's taking a break from a bull market run.
I
Right.
like the consolidation for a long time.
Yeah. So to me, I see awesome support at maybe 1,200. If you guys know Jim Rogers, he's a famous investor who worked with George Soros. They were part of the Quantum Fund. They said to him, he's like, he bought a lot of gold. He's not buying any more gold unless it goes below 1,000. But I see pretty strong support right here at 1,200. It seems that every time we break below it, we revert back in. But if it does go to 1,000, hey, I'll buy some more gold miners. Yeah.
You know any sources that track like who's buying gold, like maybe the physical gold, like what countries?
Yeah. So in the 200, if in gold. So beginning of this year.
Like how much does China own gold?
So yeah, China and Russia own about the same amount of gold, but actually USA owns the most. I think it was like 8,000 tons. TONNES. I don't know how to pronounce that. Tones, tons. And China's only like a small portion of that. But in the past year, or past few years, they give you updates on who's been accumulating gold the most. Russia and China have been buying gold a lot. And it made sense when we recently had our discussion on the Chinese economy, where they sealed off their economy and started printing like crazy, and then bought gold. Man, that's the most shadiest thing you could do, right? Now let me just repeat that. Sorry, I'm gonna mute somebody real quick. Sorry, Sylvia. Okay, well you got it. Let me just explain that concept to you real quick. let's say this room right here, everyone in here is in a little economy, a major economy, okay? And I control the money supply, right? And you guys agree just because we're all using the same currency. And then one day you guys get sluggish, I have to pump you up. So I start printing money. So I start handing out more money and you guys start transacting, start doing business. But at the same time, well, let's say I forgot one component. Everything was tied to gold. I depeg it to print money, right? In order for me to manipulate the supply to get you excited, I gotta cut that connection to gold, right? And now I start printing. And then on the backside, I start buying gold. You see the dynamic there? So that's kind of like what's happening around the world. So in Gold We Trust, these two great money managers, I guess, they wrote I guess you could say, a super awesome paper. You see how it says 0 days and hours left? Earlier on this year, I was waiting for like a month, like, oh guys, it's coming out in 30 days, and we get to read it. And so it finally came out. You guys could download as well. The extended, you could read the compact version, which I think is about 50 pages, but you could read the extended version. The extended version is super awesome. Maybe I could pull up some insights from the In Gold We Trust. Let's see, In Gold We Trust. TD number 70. Was it beginning of this year? Central banks and monetary policy. Well, let's try this one. In Gold We Trust. So this is number 74, right? Today's number 97. Technical discussion, meetup number 97. This was number 74. Is this the one? Okay, this is the one. So this is the report that I read. And today we're talking about a completely different report. Hey, welcome. Nice to meet you. I'm Kay. Don't worry about it. It's people kind of walk in. Let me see if I can show you some insights. So you asked me who owns the most gold, right? So U.S. owns about 8,000 tons. Tones.
I'm just kidding, I don't know how to
Yeah, I don't know how to pronounce that. But they own about 8,100, right? China and Russia own the same amount, about 1,800. So now you get an understanding, right? Like why do you need to own gold? So I feel like because the facilitator of this game, the USA, or every major economy prints money or creates the money supply so we all transact, it's only when what they do doesn't make sense, they themselves go buy gold because they're afraid they'll lose control. So it just makes sense from a sovereign perspective. And if you're a professional money manager or a money manager that's managing like billions of dollars, you start looking at gold, right? So Mr. Simmons, quantitative fund guy, he owns like quite a bit of shares in gold miner stocks. KGC is one of his positions. KGC is a gold miner stock. So this is the big picture right here. So I'm seeing that whatever's happening in the world right now, if you look around the world, Nikkei, Japan is kind of like going sideways, looking like it might want to break down. Europe's already breaking down. DAX, German DAX is breaking down. So you guys have to understand DM versus EM. DM is developed markets, and hey, welcome. EM is emerging markets. So emerging markets would be like China, Brazil, India, Russia, stuff like that. And then DM, developed markets, would be like USA, Europe, Japan. So when I say S&P 500 is kind of breaking down, or not yet, but pointing down, Europe, DM, is already breaking down, DAX is breaking down, that's a major concern because that could be spillover to our DM, our developed market. And Japan's kind of falling too. So how do you track that in real time? I get kind of lazy these days, so I just look at the futures market, and then I go to indices on finviz.com, and I could tell from just a visual analysis, right? Wow, well, Europe, the top 50 stocks in Europe already broke down. So I'll show you a breakdown. So as traders, right, we look for, I get lazy sometimes. I just look for a breakdown. So Russell 2000 is a U.S. small capitalization companies, right? It's already breaking down. But let me show you Nikkei. Nikkei it didn't break down yet, but it's looking scary like everything else. But we want to focus on Europe. This is Europe right here. So Europe's top 50 stocks are what? Like their Apples, their Facebook, their Googles. It broke down, right? It's hanging down there. It's not good. Now, why do I look at breakdowns? Let's go to cryptos real quick. Anyone remember what happened when Bitcoin broke down from 6,000? What happened right here? We were looking at this line. It broke down 6,000, almost cut in half. Right? So I'm using the same price action dynamics to see what's going on. What do traders, investors, money managers, all the participants in Europe are thinking? And what I'm seeing is, well, they're being really negative because they're allowing things to break down. It's pronounced ton. Okay, all right, thanks, Chris. So tonne is ton. Okay.
Isn't that just a mirror image of the S&P and the NASDAQ? I mean, they're all kind of following the same.
Yeah. So if you notice, we have indices right here, right? These are all DM indices, developed market indices,
Right.
right? And they're basically the heart of the economy. And I became more, my thinking about the indices became more reinforced when I became a real estate agent about 6 months ago, right? So we used to be in a Milpitas library. We not in this room right here. So 6 months ago, the indices, like I used to just watch equity markets, right? Now I got into real estate and then kind of understand how the real estate agent breathes and all that in this office. And basically, I always say, the indices dropped in February, right? Stock market dipped in February, and then March and April, all the agents felt it. So I see a 1 month, 30-day, lag, which is kind of interesting. So I want to primarily follow stock market first, and now I'm even more reinforced when I recently read the central bank report saying that, well, their number one vulnerability is asset valuation pressures. So they feel the stock market is too high. So, and they think that ultimately can hurt the economy. So now I'm getting really bullish on gold. So I'm kind of pitching an investment thesis right now. You guys kind of follow so far, or is it a little too technical? I try to break it down pretty easy.
So how does investing in gold different from gold miner?
Yeah, so gold. So let's say gold is the commodity. You're buying the actual commodity. It doesn't really do anything, right? But the gold miner are the people who, like, they have the researchers who go out there specialize in finding ore bodies, gold ore mine bodies, whatever. The main difference that I see is gold is cheap right now because it went up really high and then it dipped and went sideways. But they say gold miners are even cheaper than that.
Can you put up a comparison of GLD to GDX?
We could, yeah.
That's miners to the actual metal.
Like, are they possibly correlated? Are they correlated?
Yeah. Like if the gold prices go up, everything they mine, their margins are fatter. Think about it. Like, let's say you're a gold miner, right? And every gold piece you sell for $1. Gold jumps to $2. Everything you mine now you sell for $2, and you get a fatter margin. Your margin just expanded, right? Something that I like about software companies because they naturally have fat margins. You guys understand the concept of margins, right? So for the new people, margins is basically you run a business, right? You sell a cup of coffee. The resources cost you $2. So every $5 you sell for a cup of coffee, the one that Chris is drinking, they make $3. $3 your profit margin. So the gold miner concept, if right now gold's been, I mean, it rallied like crazy, but now it's going sideways. They had time to repair themselves. They had years and years. These gold miners are efficient at this point, right? So I think as they expand, they're already efficient. They're going to get even better. So they're going to be really good at capturing, the economic demand, or at least the go-to market strategy. So I like that. I think they'll be able to deliver, and that's why I went for the best in breed for gold miner stocks. I think we have some comments online. Let me just make sure. So if you guys want to see my watch list for gold, if I were to share with you guys, these are the gold stocks that I'm really bullish on. Now, educational purposes only. Okay, I'm not recommending anything. I'm just showing you what I like. So KL, I think they have access to a very rare ore body. So if you've seen the last, I don't know, the 2 weeks that I've been gone, 2 weeks of volatility, this has been performing. Now, let's take a little step back as to why I like gold, right? So what I have right here is ETF insights. They're basically, it shows you, it's just a list of ETFs and how they perform as of Friday, right? 12/7, December 7th, that was Friday. So the results were, for US ETFs, everything was down, right? IWM, okay, American indices are down, all right, small cap, Dow Jones, S&P 500, mid cap, small cap, NASDAQ was all down, right? Transports, if you want to get a little bit deeper, technology, financials, healthcare, media, consumer discretionary, all down. The only one that was really up was gold miners, right? In the past 3 months, gold miners returned 10%.
So is there an ETF for gold itself?
Yeah,
GLD.
yeah, GLD.
GLD.
Yeah. So now that's take a step back. Which one do I like more, GLD or GDX?
So you asked how does it compare?
Yeah, I'd
How
like to
does-
see a comparison between the two.
Yeah, yeah.
See
Which is
which one's
performing better, the mineral or the?
Sorry, I
miners?
didn't answer your question.
So, hey, you know what I'm gonna do? I'm gonna put up GLD with GDX on
Okay,
the miners on
okay.
on the weekly, so you guys can see exactly.
Yeah, if you want me to send that to me, we can do that. So, I mean, from just looking at this, everything in the past quarter has been underperforming, right? Just look at this row over here, right? Except for utilities, yeah, I've been seeing a lot of people buying utilities, at least in the market action, and then gold miners. So those are the two safe havens I see. Now the other one is, if you're long volatility, that's been the best market. Playing the VIX, going long the VIX. I think VIX could still spike. We haven't had a capitulation event yet. Meaning we didn't have like a crazy sell-off yet. What you saw in the past 3 months was not crazy apparently. It's going to get crazier, according to the VIX, which I performed quite a bit of analytics on.
Is there any possibility that this kind of mixed volatility will just be,
Nerfed or
Yeah.
or decayed? Yeah, so it's all about the wording of the central banks now. If you recall, so when the financial stability report released, and it was the day we emailed each other, that was the day they started sounding very dovish, meaning they were gonna not raise interest rates. They didn't sound so hawkish that I'm gonna raise interest rates. And then the markets reacted with a huge bounce, but that bounce retraced now. So markets are still looking scared. So I apologize. I know Chris has been coming for like maybe the past month or two, and every session sounds kind of bearish.
Oh, no, I don't mind.
Yeah. Yeah. So
Any of this interesting.
yeah. So I mean, you gotta kind of be honest about investing, I guess. So things are looking bearish. Did you get that chart yet, JC, or you want me to? Okay. So yeah, that's what I'm seeing in the market. So let's dive into this report. Did you guys have any comments on gold? We'll revisit.
Just one comment.
Yeah.
So basically, if I can repeat your points, first one, we are looking at inflation because of money printing, and gold seems to be safe haven. That's point number one.
Right.
And point number two is money should go somewhere from S&P 500 and such, and they need to be parked somewhere. They can be parked in cash, in bonds, and other things like gold. So that's another source. There is huge number of sectors of economy which are competing with gold for this money. For example, energy, oil. Gold by itself doesn't have really any value except some jewelries, and it doesn't have industrial application.
Yeah. There's no application.
Unless its price really goes down, like on pair with silver. So we have energy, which is oil. It's not going anywhere.
Yeah.
Plastic, cars, everything.
Yeah.
The second thing, utilities, infrastructure.
Yeah. Yeah.
Infrastructure costs money.
Yeah.
And the last thing is...
So utilities went up. All right, that's not bad.
So,
Yeah.
yes, but not much. Well,
Yeah.
they went up with the rest of the market, so they are kind of above their kind of natural value, I guess.
Yeah.
And the last thing is overall materials, not just gold, but copper,
Yeah.
silver,
Yeah. Yeah.
even coal.
Yeah.
So why gold? Because these are large sectors, they can
yeah.
consume a lot of money.
So gold is more, the reason to be bullish on gold, the way I see it, it's more social than scientific. There's really no application besides a trust application. You know what I mean? Like, do you trust the other person?
I totally agree with you. Once it will start going up, and kind of it will have first dip, and then will kind of
Yeah.
have next high.
Yeah.
After a couple times like this, it will be unstoppable.
Let me address those two.
It's been the alternative currency for thousands of years.
Let me
That's,
address the two issues. So basically, gold, what it does, it has a history of maintaining its value.
Yeah.
No matter what happens, it's going to maintain its value in relation to everything. So you have a big percentage population that just trusting gold so much that there's a lot that they care about gold. They think gold is worthless. There's a huge population that care about money. And as far as addressing it, there's a lot of things to invest. We're talking about trillions and trillions of dollars. Even if they go to oil, silver, treasury bonds, whatever, there's plenty of room for gold to go up. If inflation takes hold, right? If inflation does not take hold, gold is going down with everybody, right? If inflation takes hold, all the money is going to go to different places, and gold's going to get huge, it's going to get huge money that's the reason why, the trust, maintaining value, there's plenty of money to go around.
You happen to look
so-
at the chart of gold from year 75 to 2005.
I did, and I also compared it to the inflationary pressures in 1970s when inflation took hold. Gold went from like 200 to like 1200.
Yeah, there was huge
Yeah,
spike.
so I'm saying with
Yeah.
inflation, it's gonna spike every
But
single time.
So
Because inflation went lower.
So when we talk about gold, it's very at the sovereign layer. It's a sovereign universe. So when I say sovereign, imagine you create money. You own all the money in the world. How do you sustain power? I mean, it's a crazy like this is like you come to an investment class thinking like we're talking about different. This is philosophy at this point.
The question really is what will make fund managers to get gold in their portfolio and what will keep them adding gold to their portfolio. That's the only way how
Yeah,
it's going to
the reason is money printing. If they're gonna devalue the dollar, then it just makes sense to jump to something that's fixed. I know,
I put in the chart for us, to compare the
Yeah.
GDX to gold.
yeah, so let me show you this real quick. So what I said earlier about DM and EM, on the left side is developed market, on the right side is emerging market, right? So on the left side, advanced countries, gold is about 19% of their assets. But on the developed side, it's about 3%. Assuming developed markets more intelligent than emerging markets, just an assumption, right? Or more advanced at least. Why are they holding more, gold?
Historically.
It's what?
Just because
Yeah.
historically they own more.
Yeah.
But in the recent years,
Yeah.
because of the US dollar has already take off the hook between the gold and US dollars, so that every developed country has already kept decreasing the gold ownership.
Right.
And US dollar definitely has a strong hook with gas, oil.
Yeah.
So that also every oil transaction
Yeah.
you make
True.
$1.
Yeah.
So like that, I don't see any good point
So-
that we should
so,
look at it.
Yeah, so if you guys know at the sovereign layer, right, the biggest deals, I thought mergers and acquisition would be the biggest deals ever, right? But I think maybe commodities might be bigger. And so you're right, like what sovereigns decide to trade with each other is very important. Do they decide to perform it all in the dollar, like the petro or some other currency is extremely important because you guys know what sovereign wealth funds are, right? Like you think Masayoshi Son, his venture capital fund, the Vision Fund at 100 billion is big. You think Ray Dalio, the biggest hedge fund manager in the world at like I think 120 billion is big? Sovereign funds are in the trillions. At least Norway. Norway's sovereign funds and it's a 1 trillion size fund. So Sequoia Capital is not even that big. Sequoia Capital is number one VC firm, right? How big is Apple? About 1 trillion market value, but not anymore, 800 billion. So how's a sovereign fund at 1 point whatever trillion? Think about it. So if you go research how do sovereign funds get funded, it's through oil exports or some commodity transportation. So every time some country decides to buy oil from them, they export it, they get a little cut, and the fund keeps growing. Right? And the fund will grow even quicker because let's say they print money, so it gets pretty complex in thinking. So let's take a step back. It's just a higher level game, like a game where you define the rules versus at the corporate game. If I go into like corporate, mergers and acquisition or investment banking, I have to play by the rules. But if I jump to a sovereign level as a politician, it's kind of like at that point you kind of define rules with weapons and commodities and gold. So it's a totally different level is how I view it. Which us average Joes, we can't really invest at that level, but we could understand that level and then respond intelligently through investments. So it's interesting. I never thought of myself going that high to the sovereign level. I've only gone as far as like small cap stocks to like large cap stocks like Apple. But to go higher than that, you start thinking about bonds, for forex, commodities, and all that, and then you hit the sovereign level, which is kind of crazy. But I'm gonna stick to this level. I'm not trying to get put away or anything. Just want to earn some money. But yeah, this is your chart,
Let me
right?
make a few comments on the chart. So
Yeah.
basically, this is going back in 2005, since when GLD started, and it's a weekly chart. So if you look at the candlestick, that's basically GLD gold.
So real quick, GLD is this one. So this is gold, and then the golden color is the gold miners.
Right, and basically what you
Yeah.
And then they're gonna correlate perfectly, but the only difference is gonna be that the gold miners are gonna be like 10 times to 100 times of leverage.
Yeah.
If you look at the high of 185,
Yeah.
on the gold mine down to $12.
So that's a good, what the word he uses is a good way to, I said gold miners are relatively undervalued compared to gold, but he defines it as leverage. That's a
Extreme
correct, yeah.
leverage. You can see it right
So
there.
that's why I'm in gold miners, because I think it's way more leverage than.
So if you thought gold was gonna go up, you'd have more leverage buying gold mining stocks, what you mean?
Yeah,
Very
yeah.
first.
I want to take advantage of my time premium that I have, right?
No,
In terms of like age and play.
But there's a perfect correlation between the two, and obviously if gold's gonna go up, this is gonna go, extreme leverage
Yeah.
higher, the same thing going down.
So that's why again, guys, I'm not recommending anything, but these are my
Can I
top.
make a quick comment on that?
These are the top gold picks. Yeah, yeah.
And then on gold, basically what happens on gold, when it goes above the 50 MA and the 200 MA, which is the blue line and the red line,
Yeah,
that thing skyrockets because inflation's taking hold.
yeah,
And gold hasn't done this since 2013. It's been below the 200 MA and below the 50, right? So now it's getting close, the lines are kind of evening out. And I'm saying to you that if it goes above the 250, it's a great time to get in with that as a stop. Because you're going to stop right below your feet.
yeah,
And then you can take a skyrocket to way higher on that, on gold. And if it drops below one of the MAs, you get out.
yeah.
Now, right now, it's not the time because it's still below the 200 MAs. It needs to get above all of those lines to get, blue skies ahead without any MAs on top of it.
Yeah.
Then it's time
Yeah.
to go.
Yeah, so I learned now that the best investments are let's say a stock. It's not when the PE ratio is low. It's when the PE ratio is negative. Does that make sense? It's not when the best investments are not when the gross margins are positive. It's when the margins are negative. Because nobody wants to buy it when it's negative, and then you get in first, and then you anticipate that. So there's a lot of forecasting that you got to do. But Chris online shared a link, and it looks like a sovereign wealth fund rankings. And what we said earlier, Norway was the biggest fund, right? So Norway at 1 trillion, China at 900 billion, right? So when you hear like again Masayoshi-san raising $100 billion fund, no, these sovereign funds are way bigger, right? And how do they protect their? At that point, you got so much money, like, it's just ridiculous, right? Like, the more I think about it is this game that we're playing, right? We keep printing money, and then the best players, typically capitalists or investors, they reap the benefits of asset, inflation, right? And then in a bear market, they'll take it all out, and then the 5% of the money, which is owned by 90% of the population, who don't study finance, they lose to it. And so the government has to print money to redistribute that money to them, but at the same time, further making those asset capitalist holders more rich. But it makes sense because, like, let's say again, let's go back to that. Hey Shanti, let's go back to that game of Monopoly, right? I'm printing money, right, and then all the money seems to go to like the best 5 people in here. So let's say I print 100,000 in here in this room. And for some reason, the top 5 players in here own like 99,000. So what do I do to help the other people?
print more.
I gotta print more, but the smart guys keep winning because they keep playing this game. So that's what I'm slowly realizing. It's cool. It's awesome.
It's free market. It's just free market.
It's free market, yeah. So the more that I understand these economic concepts, the more I guess it's more fun to go out there and just chat with people and see like where their thinking sits on the this global framework or whatever. So yeah. Any comments before we jump into the report? If you guys find the report too boring, we can do something else. But stock recommendation wise, there's a lot of great stocks that are like low, like Microsoft, but I just don't know how much lower it could go because I can't predict the environment. Good? Or any questions or? Okay, all right, let's jump to the report then. Let's look at this sovereign wealth fund real quick. All right, Qatar Investment Authority, 320 billion.
I don't see US on that list.
So I'm not an expert at
US tax.
yeah, I'm not an expert with sovereign funds, but if I were to be if I was a sovereign fund broker, man, that'd be a cool job. But then that'd be a too risky job because you might find out some information that some politicians don't like. So I'll stick to the corporate, mergers and acquisition
I
level.
think I might have answer. So if you take a look where sovereign fund, what is their origin? And usual origin is there was some resource huge which would belong to the state. So what they did was Norway. It came from oil in the Northern Sea. So all profits from the oil came into this fund. And then there was management who decided what to do with these profits. So they invested in something else. And the same Saudis and the same someone else over there.
Yeah, I saw Alaska was on that list.
Yeah.
So Alaska probably had something.
Yeah,
In
so-
the US and Texas, most of the oil belonged to private people. So there's
Do-
no sovereign fund.
Question to you guys: do you guys like the sovereign discussion, that level, or do you want to stick to like corporate equities and bonds and all that?
Dumb it down.
Dumb it down more?
Yeah.
Okay, sorry. Well, that was a higher level, but yeah, we'll go back to let's go see what's going on in the economy. How about that? Can you track these sovereign funds' performance and portfolios? I think so, but I don't perform too much analysis on that. If anything, they manage way more money than hedge fund managers. That's why. Yeah, they're not. No, they're not gonna reveal all that, man. No way.
Can I make a suggestion?
Yeah.
So last week, obviously, was pretty devastating, Wednesday, Thursday, Friday. So did certain stocks go down more than they should have based on the fundamentals, or is it just a group fear that everything goes down, so everything
Yep.
goes along
Yep.
with it?
Yep.
And if the fundamentals of the companies are strong, they're
Yep.
more likely to return.
Yep. So if you read in many investment books, they always talk about irrational exuberance.
Uh-huh.
We will take things way below book value when the numbers are like, what the heck? It's making money. Example would be like GG. GG is Gold Corp, right? It's a gold miner, and it's way below book value. So this is GG right here. It's trading at 0.59 of book value. That means it's trading at, its market cap is 8 billion, right? But its total assets is like 15 billion. If it were to liquidate today, you would make 7 billion. All right? You would make 7 billion, but in terms of illiquid assets. Now you gotta go sell that. I would sell those assets for half and take 3. Or even fire sale that and then take just 1 billion for myself. But I don't own majority shares to say, hey, we're taking it private or whatever, right? Yeah,
I keep telling you guys this, that S&P 500, right, whatever that does, all the other stocks are gonna do it.
Yeah,
But
so-
a good rule of thumb is gonna be this, right? If the S&P 500 goes to if you look at the weekly chart, S&P 500 goes to the 50 moving average, right?
Yeah.
You can look at any other stock, and I'm telling you guys, all those stocks that are related to it are gonna go to their 50 MA.
Yeah.
So that way you can pretty much know where they're going in relation to their own setup. So if the S&P goes to the 200 MA, which I think it will pretty soon, I think all the other stocks are gonna go to their 200 MA. So then you pretty much know how bad it's gonna be for each individual stock if you do it that way. And it's
Yeah.
really helpful to do it that way.
Yeah. So
Can I put a basic question?
yeah.
Uh,
So real quick, starting 2019, I'd probably do more sessions to revisit the basics. So more like how to do technical analysis, because I want to reinforce that too, and how to do financial analysis, like jump back to the basics. That'd be something you guys want to see in 2019.
Yes.
Yeah. Okay, yeah, we could jump to the basics.
But right now, does any financial analysis doesn't match what's the stock market going?
No, it works. It works when I see it work.
But this very strong shape.
So I see it work. It's just I've been seeing a lot of central bank intervention. They influence it more. It's like we all know the rules of the game, right? But when the rule maker talks, I was like, oh, he just changed the rule. We gotta go pay attention to that guy.
I think technically are working perfectly right now. I mean, we break into 50 MA
It's-
completely on the weekly. We're gonna go to the 200 MA, so it's not, and this is what
Yeah,
was
yeah,
telling us is
yeah.
making sense of the market. What's not working is fundamentals because fundamentals, the PE on fundamentals are gonna go lower. Everybody says this is buy. It's gonna go lower and
Yeah,
lower.
yeah,
So the fundamentals are the ones that are not gonna work and the technicals will work.
yeah. Yeah. So let's jump into the report. Help you guys get a better understanding of the economy. And this is the most recent, fresh report, right? Pretty sure if you go online, you try to watch stuff, it's all about maybe 6 months lag. I don't know. But this is pretty fresh. If you guys want the report, I could send you a link as well. But again, I was saying it really categorizes into 4 major categories or vulnerabilities. One is asset valuation pressures. 2 is borrowing by businesses and households. So on top of them tracking asset values, commercial real estate, residential real estate, stocks, bonds, whatever, they feel like those things are overvalued. They also track the borrowing that businesses do and household borrowing, so consumer borrowing. So consumer borrowing is an example of like auto loan, mortgage, credit cards, right? But business borrowing would be more like, I don't know, like a SBA loan, small business loan. So some highlights, I'm not going to review everything, right? But I'm just going to share some of the highlights I saw. So central banks really feel that overall asset valuations and risk appetite are elevated, right? And with the coming volatility, the risk appetite is probably going to go away. But asset valuation appear high relative to their historical ranges in several major markets, suggesting that investors' appetite for risk is elevated. So when you hear a central bank say they feel that it's elevated, don't you feel like they'll be more hawkish and raise interest rates, putting pressure on stock prices? Is that a fair statement, JC?
In general, I mean, yes, but with this Trump thing, that he's bullying the Fed into changing his mind within a week.
Yeah.
Or we're gonna go 4 rate hikes next year, now we're suddenly going to 1 next year.
Yeah.
It's gonna lose the credibility of the Fed, and that's not gonna be good for the markets.
Yeah.
Because the Fed they're supposed to be independent, they're being bullied into decisions.
Yeah. So some of the assets that the central banks are tracking, number one, biggest one, 33 trillion, is stocks. Number 2, residential real estate, also about 33 trillion. Number 3, commercial real estate at 21 trillion. Pretty interesting stuff, right? And then they track treasury securities at 15 trillion, and then all the other stuff, right? High yield corporate bonds, leveraged loans, these are more a little bit sophisticated. But that's what they're tracking. So I thought I'd share that with you guys. Total size of the equity market is about 33 trillion and similar in size to residential real estate. Move along to the next few pages. Equity prices are somewhat high relative to forecast earnings. So not only are their stock prices are high, but also to the forecasted price, right? Commercial real estate. What did I put right here? Okay, central banks hinting how they feel about equity prices and also equity price forecasts. Looking at commercial real estate, prices have grown faster than rents for several years. Now, I went to a real estate meetup, and I met commercial real estate owners from Texas, and they own about 200 units or whatever. And they gave me like pretty good reasons about how they feel about this market environment. They're saying right now they are, what was the word that this gentleman used? They are conservative sellers and strategic buyers. We're opportunistic buyers.
Cautiously optimistic?
Yeah, something like that. He's saying like, cap rates are low. In commercial real estate, one of the key things that every investor looks at in commercial real estate, and you should learn this, is cap rate, capitalization rate. And then the opposite of that is, it's just the PE ratio. If you guys know the price to earnings ratio of a stock, cap rate is equal to earnings over price. So it's just the same jargon used in a different market. That's all it is. It's not that hard. But to give you a visual of where cap rates are nationally at an average, if you look at 2008 when everything was tanking, this is commercial real estate only, okay? When we talk about cap rates, it's only commercial real estate. We could talk about cap rates for residential, but I don't think they normally do that. So in 2008, cap rates were as high as about 7.5 to 8%. Right now, cap rates are at 6. If you look here in Silicon Valley, it's actually like 3 to 4 cap rates. Now, you're like, what does that mean, right? Cap rate means, if we go to LoopNet, real quick, LoopNet is the portal to where you buy commercial real estate, right? Just like how this is where I buy stocks. You could buy businesses as well, but let's just look at California, and we'll do the standard multifamily because that's typically where investors go, when they start out. This report was published before the FOC. Yes, it was reported maybe like 2 hours before the announcement. So this is how you buy commercial real estate, right? You go in here and you're like looking like, 4% cap rate. That's really low. Meaning if we put down 2.2 million, we get 4% every year in income, right? After all expenses. So that's really what the quick cap rate indicator is.
That's income from rent?
Yes, rental income. And you could click on it and just look at all the operating expenses and all the tax expenses and stuff. But to me, it's like, 4% is okay, but it's leverage because you have access to banks giving you more money. You don't get that type of access in stocks. with AT&T paying like 7%. Huh? Huh?
So you mean that renting is what's the capital rate?
Yeah. So it's a simple dynamic, right? So let's say, here, let's go back to that example. I'll make it easy for you guys.
So you
So
mean that renting in the Bay Area is more smarter than buying?
Basically means you can use leverage with debt so that your 4% return is actually significantly higher because it's on a smaller percentage of the capital. So you could buy 10 of those buildings, financed, let's say 90% debt. You're still getting the income from it, so your leverage gives you more than a 4% return overall.
yeah. So that's the cool part of it. That's the difference, the main difference with commercial real estate. So 3%, right? So I like to think of it as this. It's a simple lever, right? If right here is about, that's 4%. 4% is the rate, and the price is 2.2 million. 0.2 million, right? So if interest rates are going up, or if cap rates were to go up in a recession, which it did, sorry, I'm going around too much, but in 2008's recession, cap rates went from 6 to 8, right? So what happens when this goes from 3.4 to let's say 6%? Then it will bring down the price. So when I talk to a lot of commercial real estate investors, they're like, oh, I want to wait until cap rates go up. Meaning let the asset price goes down. Because the beauty of that is that if you let it go down, if you let cap rates go up to like 6% and price goes down like whatever percent, then you can find those value add opportunities. And you're finding opportunities that are not really 8%, but it's really like 12%. Because you put the value add.
So,
It's
okay,
kinda
this
nice.
cap rate basically talking about the value of the entire building itself, not
Yeah.
how much down payment you put on, how much they have
Yeah.
financed, it's just the total
Yeah.
value, whatever it is.
Yeah.
And it doesn't take into account the mortgage pay and all that kind of stuff, it's just basically the rate they're getting for X amount of dollars of the down.
You know, that's a good question. I'm not a super commercial real estate expert, but maybe I would double check and see if that's incorporating it. But it just gives you, to me, it just gives you a quick indicator like, okay, if I put down this much, how much am I gonna get paid?
In a fancy word, if your cost of debt is less than 3.99%, if you had $1 billion, you could buy every piece of property and still make more money because of the leverage.
But I'm comparing somebody that.
You know what I mean?
Yeah. That's
Somebody
crazy.
puts 50% down payment and 50% in finance, the other one comes in with 10% payment and 90% finance. Is this for both of them? Is this for both of them?
You're right though. The leverage is attractive.
Think of it this way, if you could get a 4% return, but your cost of your debt was 1%, you're making the difference, right? Just it's simple math.
Yes.
It costs you 1% loan to get 4% return on the same amount, so you're still making more money than it cost you to put the money on the table. You're using other people's money to get the difference.
Yes.
Yeah. So it's also attractive, like you do get the same leverage dynamics in owning a business, a small business. The cap rates are about 50%, right? But 50% leverage. That's kind of nice for small business.
On this scenario, that if you put 5% down payment, right, and let's say you get the 4%, and next thing you know, the value goes on 10% because of the leverage.
Oh,
you
okay.
lost so much
okay.
Well,
money.
that's right, that's the exact opposite.
Okay,
Right.
there's that too.
Leverage
Okay.
works against you
Yeah,
too.
yeah.
So I'm just saying, the leverage works both ways.
We were just talking how nice it is. Yeah, you're right. So that's why the guy who mentored me, he's a hedge fund manager, and he built his wealth off of I guess you could say all the years of appreciation, but he focused on commercial real estate in the retail segment, not multifamily, retail. And what he did was he would buy out the entire lot at 70% occupied, and just put in 30% find someone to fit up the 30%, and then he'll triple net lease it, turn that into cash flow, recalculate the numbers and sell it to the market. So that's essentially what he did to build wealth. It's the same thing as flipping, but it's not physically laborious. It's more financial and deals driven.
Are you talking about wholesaling?
No. So he would buy like let's say, so you know the Cupertino Main Street right here? Or right across the street, okay, any plaza. Just think of any plaza, like Santana Row. That's a really expensive plaza, but maybe like a lower key plaza. Think of any plaza. Let's just do Santana Row. Let's say right now Santana Row is at 70% or 70 million. 7 million. 7 million is a little low. Too low. 70 million, 70%. If you could occupy 30 more percent, then you added value. That's what he essentially did.
So just think,
That
like
makes sense.
in Crystal City, Virginia, where Amazon is moving their headquarters.
Yes.
If you bought $1 million house with $1 million cash, and the house went up 10%, you made $100,000. But if you used 10% down only, and the house still went up to 10%, you've made 10 times as much money.
The beauty of leverage.
Do you get the idea?
But you also, if you bought a house when there was a fire, it got complete, the whole.
But if you bought it and it went
You are
down,
using the money.
It works exactly the opposite. You
Exactly.
put in 100,000, you lost 100,000, so you lost all of it.
Plus more.
Right,
It was
right.
a minus one
Right.
hundred thousand percent.
So let's get back to the analysis of central banks and how they view commercial real estate right now, right? So they view stocks as a little overvalued. Now looking at commercial real estate, they feel that prices have retraced since 2008 for commercial real estate, and cap rates have hit a new low as in right there. So commercial real estate is quite overvalued. Is that a fair statement? In terms of like what the central banks are seeing, right? So that segment's a little overvalued. So you really, I mean, you gotta really find a value add. But
So we are waiting for a great time to get in, right?
I'd say so. I'd say so. If you have the time benefit, and home prices have been rising, but less so in recent months. So now moving away from the commercial real estate, looking at residential, house prices have risen substantially since 2012, substantially. Although the rate of price appreciation appears to have slowed down significantly in recent months. Hey, welcome. You here for the investment club?
Yeah.
Hey, welcome to find a seat somewhere. Anywhere is fine. Maybe you could grab a chair if that's, or you can sit next to me if you like. Yeah, I don't mind that. Yeah. Where was I? Measures of house prices relative to household income also suggest somewhat elevated valuation pressures in residential real estate nationwide. So it's a little scary to operate at that level, though I met some developer in like the past 2 weeks. So I did open house at a $3.1 million home, and this home is like 0.28 acres, 12,000 square feet. And I'm there looking for a buyer, and I see this McLaren pull up, and I'm like, oh, that's the perfect buyer. And then it turns out this is the owner. And this guy, he didn't flip homes. He started in 2012, which is a great time. But what he did was he just went in and started developing homes, one a year, since 2012.
That's great.
He's still doing it now. But now the home that we're trying to sell for him, 3.1 million, our team, it's asking for 3.1, but we're probably gonna knock it down. So the market is slowing down. The trend right now is whatever you ask is slightly below ask. So that's the trend of the markets. And it kind of reflects what's going on in the stock market. So I feel like no matter where I go, I'm gonna look at the stock market because it's a lot more superior, or at least the liquidity nature of the stock market gives you a quicker response time to what the real estate market would do, because real estate is more illiquid, right? So I guess big money likes to move fast in the stock market. Looking over here, housing price to rent ratio, not as high as 2008. Isn't that interesting? Right? The price to rent ratio. So it's pointing up, but it's not as high. So if this was a bubble, it wouldn't be a subprime mortgage bubble, right? This is overstretched because everything over there was about mortgage derivatives, right? 2008 was about mortgage derivatives that exposed the entire world.
So this is price to rent, so it's comparing with the buying a single house to a commercial.
No, not commercial. Just
Maybe
the
just any
yeah.
unit rent.
Yeah.
But is it maybe just because after the financial crisis happened in 2008 and people are starting renting more and developing more renting purpose real estate, so that this ratio doesn't go up a lot.
Yeah.
But so it means that this ratio is not like too, what's it?
Not too overstretched or anything. Yeah, not much of a vulnerability point, or nothing too critical.
Yeah, it's index
Yeah.
ratio.
So that's basically what we do as, I don't know, central bankers, economists. We look at indicators, right? Investors do too. I'm looking at a macro level because I really, this stuff really interests me,
Sure.
especially when there's no investment opportunities in momentum stocks right now. So I go look at other corners of the investment world.
Have you thought, I think you should consider having 2 different meetups, one more on properties and on real estate.
You think so?
And one more on equities and investing overall.
Yeah,
I
I thought
think they're very different subjects, even though there's a
Yep,
relationship, but I think they're very different.
I think so too. I wanted to, up here I had some updates about myself, right? Like you guys are probably wondering, like, hey, where do you go for 2 weeks?
It's like two people just said the same thing.
Different
Different
yeah.
meetups, and someone said yes before that too.
Okay, like more focused on stocks. Yeah, I
Well,
really
they're-
like stocks.
It's fascinating topics, but they're very different.
Yeah.
in terms
So
of,
so if I were to start the real estate meetup, it'd be more around real estate investing, leveraging, financing, sourcing deals. Definitely, I think that's a major one. Like sourcing wholesales, like
that's almost another
learning-
subject.
learning how to pick up the phone and just
Right.
have a conversation with people. So I'm actually in talks with to train a younger gentleman on how to source deals. So this guy, alternate between the two every Sunday. Yeah, maybe I could, Darsh. I'll try. That's asking a lot. We'll see how this club evolves. Okay, I just thought moving away from Milpitas Library to this office, you guys would be more appreciative so far. Just kidding. But I'm talking to this younger gentleman. I've known him for not too long, somewhat, but he doesn't come from a wealthy background. But he's 18 and he's managing a shop already. And to me, it's like, wow, this guy's showing a lot of dedication. So I might want to train him how to like source deals and cold call for me. I'm going to train him to like just everything I can, like how to use a CRM, how to talk to people, how to dress up, and be proper a little, right? So I think by the time he's 25, he can be sourcing deals like crazy. I don't know, maybe. Yeah, so that's something I want to do.
I do hate how you're saying you're talking to someone younger, by the way. It's like, rubbing the salt more, right?
Well, I mean, dude, it makes sense. Like when you're 18, you're
Yeah.
young, you're more, you can mold them easy.
sure,
right?
sure.
Like he hasn't been exposed. He really wants to succeed, but no one's given him like the right path yet, right? And so I think with his economic background incentive, I think we push him the right way. And then because I need someone to help me with these meetups, not this meetup,
Absolutely.
but the mixers, right? There's a lot of people who come to mixers, and there's all sorts of deals to source from venture capital deals. Like I literally see tech entrepreneurs come in, and yeah, like 90% of them are junk, but there was one that I really respect because they had a world-class team, all PhDs, and they really were targeting an enterprise software market, which I'm very familiar with. And to me, it's like, well, dude, if I refer this to a VC, the VC has to give you a cut. They got money to give you a cut. So that's the type of insight I like. Hey, how's it going? Hey. Yeah.
I was thinking, one thing we can add too is like, since we have a weekly meetup, just address maybe for like 10 minutes, what are the big things that are happening in the world that's gonna affect our markets?
Yeah.
For example, next week is gonna be obviously the yellow vest protest that happened yesterday, how France is gonna react to
Mhm.
that in markets. And then on Tuesday, the parliamentary vote on the Brexit.
On what?
So the Brexit.
Okay, yeah.
Yeah.
So just those two things, how
Yeah.
it affects our markets, what could possibly happen.
Yeah,
And maybe
yeah.
if we have time in the future,
Yeah.
something like
So-
issues like that.
So
I like that too.
yeah. So remember what I said? It's all about what comes first. Like you're asking me, like, what are the top stories, right? Like the top news line.
They're
But
gonna affect.
But the thing that responds first is actually price. If you look at price, that's the most immediate like answer right there. Any insider, any big shot that has information, has incentive to go respond in the public prices.
But prices cannot respond for the Brexit vote, so they have to speculate.
Yeah.
on that.
So yeah, you'll see
Yeah.
speculation
Yeah.
beforehand. I can't predict the future. If I did, I'd be like.
No, it's not predicting.
I guess you could say I have a very fuzzy crystal ball.
You're not predicting, you're basically saying what would happen if they vote yes, no, what are the implications?
Yeah.
Just our personal thoughts on that. It's
Yeah,
not
yeah.
predicting.
Yeah, so yeah, we could do that. I really want to take it to the next level 2019. I don't know how, but I do enjoy the whole investment club community because it's kind of fun. Like I actually learn from other people too. Like we had developers come in here and actually sit down, but then they're like, oh, it's too far, I can't come back. Right, so like a developer, I think you met him. He was the gentleman that sat right here. He ex-army, and he's doing like a $6 million home, developing in Oakland. So really cool people come in. Dang, I lost my spot. Okay, we were over here. So moving on to the next part about what central banks are looking at. So that was number one. Number one is that they feel asset valuations are a little high. Everything from equities to residential to, well, not so much residential, but commercial real estate. Moving on to number two, borrowing by businesses and households. So, our small businesses, logistics businesses, are they borrowing too much? There's definitely leverage in that. While household borrowing is at a low to moderate level, household, average Joe, relative to income, the business sector debt relative to GDP is historically high, and there are signs of deteriorating credit standards. It just seems that, you know, in a low interest environment when money is like essentially free, of course the people who are practitioners of a business are going to borrow money first, because I would assume they have the information first, right? At least 90% of them, I don't know. Overall vulnerabilities arising from total private sector credit, right, private business, appear moderate, or private business and households. Among businesses, debt levels are high and there are signs of deteriorating credit standards for the business segment. So that's a little bit of a risk that the central banks are seeing. In addition, recently, debt has been growing fastest at firms with weaker earnings and higher leverage. So people with weaker earnings and higher leverage are borrowing even more money. That's not.
Covenant light too.
Wait, what? Say again?
Covenant light.
Yeah.
Very little restriction.
Yeah. So by contrast, household borrowing has advanced more slowly than economic activity and is largely concentrated among low credit risk borrowers. So it seems like maybe, you know, maybe not businesses, they can't force the markets up, but consumers still can. Average Joe still buy, which would probably be the people who usually get hit. Again, business leverage is high and signs of deteriorating credit standards are there. Number two, household consumer/consumer borrowing concentrated in the low risk segment. Oh, it's concentrated in the low risk segment, meaning out of all the consumer borrowers, it's the most of the borrowing is concentrated in the prime consumers, right? Not the bad credit people, but the good credit people. Most of them are where all the borrowing is happening. And so there are some charts right here. So total private non-financial credit, so this is the total, 30 trillion, about the size of a stock market or residential real estate market. Total business credit, right, about 14 trillion. And in there you'll see like bonds, commercial paper, bank lending, etc. Total household credit, 15 trillion. So mortgage is about 10 trillion. And then consumer debt, which is like student loans, auto loans, etc. So I'll move a little bit quicker because this might be a little too boring or too technical. Let me know, okay, guys?
Yeah.
Total private credit has advanced roughly in line with economic activity. So we'll skip that part because I know there's some charts down here that are pretty interesting. Let's see. But debt owed by businesses is historically high, and risky debt issuance has picked up recently. Sorry. And leverage of some firms is near its high level seen over the past 2 decades. Okay, so gross balance sheet of publicly traded companies, non-financials, are pretty high. So if you look at risky firms versus all firms, everyone's leveraged. So they're saying publicly traded stocks are more leveraged than 2008. At least this chart says so. Right? But at the same time, on the flip side, they're borrowing more. Interest rates are at the lowest ever. Do you see where interest rates rising is so darn important?
Right.
Yeah. So corporations are at record debt levels, and interest rates are at record low levels, and we're talking about raising interest rates. That's what central banks are looking at, and they're very aware of this. Meaning they're very aware of like potentially crashing the economy, which is kind of like they wield so much like power if you think about it. Yeah. So debt loads are at record levels for publicly traded companies, non-financial, right? This makes sense because the interest expense right chart, the cost of borrowed money have historically been low. Sorry, I repeat. What happens when the combination of record debt levels, high equity stock prices, and interest rates start to rise, right? So stocks are at all-time highs, record debt levels, and interest rates are at record lows. If we raise the interest expense on people who are over-leveraged, then they just accumulate more expense on high stock prices, then there's a lot of headwind for stock prices right now. And so I feel a lot better in gold. So this is kind of like the reinforcement of why I think gold is still a better play here, or a safer play. Because, again, gold miners have so many years to repair themselves and be economically efficient as a unit, right? So their expenses should be low in theory because they had all the time, and financial profile looks good. And so if gold starts to appreciate, they will reap like crazy. They're hungry for the gold to appreciate. At least that's a educated guess. Yeah.
Do you think this is the best time for short buyer and seller?
I think
At the same time?
Yeah, I think it is with the S&P 500 below the 200-day moving average. Well, let's take a quick break from like all this text stuff and look at some charts because I think people get excited when they see charts. We could go to my trading view right here, and so this is the S&P 500, and maybe I'll remove this. So I kept it really simple for everyone, right? So what I have here is the S&P 500 and just two, this is the most recent action, and it's on the daily chart. So this is the beginning of the year right here, right? So what I have right here is the 50-day moving average and the 200-day moving average. If you guys follow this really closely, you see how I circled this box right here?
Death cross, what does that mean?
That means when the 50 MA crosses below the 200-day moving average, a major trend has changed. At least all the technicians view it as like, okay, the trend has changed. It's a quantitative technique to kind of define like a direction.
Yeah.
So this doesn't happen often. The last time it happened was 2015. Right? So it's been like 3 years since the last one. So when this happens, it's just it doesn't mean immediate bear market. It just means now we have one more data point, and I get closer to like an answer, right?
So with what you said, I don't know your name, I'm sorry.
JC,
What was it?
JC.
JC, so if you look at those peaks and declines, is there a certain theme of something took place for each of those, like interest rates were feared to go up, or China tariffs, like, you know what I mean, like a general theme of the wave to suggest that it's almost random, but that bottom of the very right could go back up if Trump says we're going to put this whole tariff thing on hold for 3 months, or Brexit's cooling off, or the France thing no one cares about, or the CFO in China and Canada, that all disappears, all that crap, and then the record sales at Christmas if the economy stays strong. So I mean, like, well, is there a certain
One quick
logical...
thing on the daily, you don't want to look at the daily at all, right? Because there's just too much noise.
Yeah,
If you look at the
it's too much
weekly-
noise.
If you look at the weekly and the monthly, then we can start talking what you're talking about.
So
We
we'll
can see-
jump over to the weekly.
Yeah, that is important.
Now it's more smooth.
Yeah, then this basically what's gonna happen is, if you ever get below the 50 MA, right? That's basically saying that all hell's gonna break loose, and you just get ready, right? When you get above the 50 MA on the weekly, it's saying everything is smooth, you stay with it, you don't get out of it until we break below the 50, right? And if we break below the 50, we stay there for a while, we're going to the 200, which is the red one. And it's just basically saying why you're gonna be on the stocks when the weekly, the 50 MA is broken on the weekly, just don't do it. If you look at historical aspect, every time you do, you're gonna get crushed. But if we get above the 50 in the weekly, there's no reason to be out of the market. It's like, nothing is gonna happen bad, nothing bad happens above the 50 MA on the weekly chart, nothing.
So
Right, so why wouldn't you be in the market? You gotta stay bullish no matter what until that happens.
so
That's one last thing. So, so we're 2 weeks left from, or let's say 2/3 of the way into the quarter of fairly impressive companies that did well in the previous quarter. You know, the Oracles of the world and Amazon.
Just 1 second. Are you guys here for your realtor?
Yes.
She's in her office over there.
Okay.
Yeah.
So all the companies, Walmart, Target, Amazon, Kohl's, all of them went down about 5% or give or take. Right? So if there's any indication of consumer confidence being strong and that Christmas selling will be the highest ever, then, you know, we're already 2/3 into the quarter of business sort of being semi-normal. Does it suggest that there's a bunch of high valued stocks of companies that have P ratios, you know, in the 10 to 20 range that are likely to return back to where they were 2 weeks ago?
May I ask one thing?
Yeah.
Did you calculate the tax cut into this report?
The tax cut.
Yeah, the advantage of the tax cut contribute to this financial report. Did you?
No. I'm just asking. If you look at Nvidia, for example, Nvidia put out horrible forecasts which tanked their stock, right?
So you asking like
That's a good example of NVIDIA, because what happened, if you look at S&P, when we went to the 50 MA, pull up NVIDIA weekly, look when it's gonna go to the 50 MA, look at the monster move that has gone lower because it wants to do it, it's gonna do it, right? So that's my point, if they're gonna go to the 50 MA, NVIDIA's gonna do it, and I'll put up an NVIDIA chart just to show you this thing.
So I know this this wealth manager. He's here in the Bay Area. He owns Private Ocean. He was actually a professor at San Jose State. Private Ocean Investments, and he manages about 800 million. And this gentleman is he has the quantitative background, right? This is the website. Let me see if I can find the team, who we are, our people. So Private Ocean managing about 800 million, if I recall. This is not a hedge fund. This is purely wealth management. So it's like, you know, hey Bernard, how you doing? How's the family? You know, like what's your estate planning like? All that. The gentleman is Dr. Frank J. Jones. PhD, MBA, but he has a track record of managing big money. And in the financial industry, they always look at it as 20% off the index. So when the S&P 500 currently at minus 11 to 12%, when it's down 20%, is when all these mutual fund managers confirm a bear market, right? Now, we probably don't have a minus 20% on an index, but we got minus 20 something percent on Apple,
Yep.
the biggest company in the world.
Right.
So maybe the index, of course the index won't show you first, the individual stocks will, but the top 5 players are hurting really bad. So, I mean, Microsoft's not down. Well, let's do it. So let's look at all the stocks in the game, right? From the top down. We already know Apple's down like 25%, right? Whoa, it's below Amazon.
And they're all going through a 50 minimum.
Holy moly, wow.
But Apple's also been in the news that the iPhone may not be selling as well as people thought.
Yeah.
Maybe Christmas sales of iPhones may not be as great as expected,
True.
and so
True.
that return may not be as likely.
Yeah,
I mean,
so-
who knows, right?
So from the top down, Apple's down 27% now, and no longer the number 1 company in the world.
Right.
Microsoft, my
Microsoft actually is.
number 1 favorite,
Yeah.
is finally number 1. But this is a critical sign. You got your top Titan down 25%. That's scary. 27, not even 25. That's scary. And we haven't seen a crazy bounce. Like why aren't people buying like a high balance sheet company like this? Yes, there's heavy forecasts. If you analyze the semiconductor segment, so all the semiconductor companies are like, okay, we're forecasting. We won't disclose who, but our biggest customer,
Right.
for some reason, is not ordering as much. So we're forecasting lower EPS. So we're seeing semiconductors break down, and you could track this by looking at the SOX ETF, SOXX. So we'll come back to the top players, but SOXX, it's already breaking down the 200-day moving average. So it's so hard for me right now. I don't know, man. Like in 2017 and 2016, every dip things would just go up. But yeah, we're seeing the top companies of the world just kind of like dipping. So Apple down 27, Amazon's probably down quite a bit too. Microsoft's down probably double digit.
I prefer we don't use Apple as an indicator because it's
So concentrated.
no, it's so special.
Yeah.
One of my MBA course, we are talking about marketing strategy,
Yeah.
and Apple is doing totally a different ones. So that if investors are using the traditional thinking mindset to invest Apple, and Apple would just prefer like very stably in the overall years, in the recent 10 years. But it should be higher, and for now it's just like the traditional investors doesn't can't find any indicator that is good for Apple. Like before, they cannot find any indicator good for Apple.
Yeah.
Yeah.
So I'm not saying use Apple as your number 1 indicator. We're just looking at like different angles, right?
Maybe
And my S&P 500 is probably my number 1 indicator.
yeah.
Right? But Apple is inside, an index. So let's look at Amazon. Amazon's down about 19% now. It was at one point down 25%, but now it's at 20%. So these are apparently world-class
No
businesses,
question,
right?
no question.
No doubt. But it's different this time.
So let's just do a hypothesis.
Yeah.
If Amazon or Apple or Walmart or Target or Kohl's or any of those had a spectacular holiday season,
Yeah.
do they start to move back up into the pattern of growth?
Extremely hard to say.
Of course, no one has a crystal ball, but are they fundamentally strong? Salesforce, the same thing.
Hey, I like
has the
that company.
fundamentals
I like-
of Salesforce changed in the last month to warrant a 10% decline?
Yeah.
Or is it just the SAP effect just takes them all down anyway, so nothing can stop it?
I
Yeah.
just look at S&P as a big train with about 100 cards, let's say, right? And you're talking about one card saying, if one of those cards starts
Right.
going low, it doesn't matter, right?
Right,
The S&P is gonna take it down, right?
Right.
So
Yeah.
My point, everybody
Like I said-
think of individual stocks, they're all going down. If the S&P turns around and we go across the 50 maybe, they're all going higher, all
Right.
together, right? So my point is the S&P, whatever that does, everybody's gonna do it no matter what. It's just gonna
yeah,
happen.
yeah.
So
Yeah.
that's, when I look at individual stock, when I'm looking at S&P below the 50, it doesn't matter. I
So
think it's gonna
That's
break.
absolutely, yeah, very
So-
true.
So I mean, yeah, it'll take down the value, but I also think that through corporate buybacks, when you buy back your own shares, it's leverage.
Yeah.
Right? Because they also taking a position in the stock. Like you buy a stock, it goes down, you're not happy, right? Well, if corporations like Yelp buy back their shares, it goes down a certain price, they're hurting now. They're losing money.
That's a good example, Kay, because Facebook just did that on Friday, right? They bought their own stock a lot of money. And what's gonna happen, all it did is gonna stop for like a week, maybe
Yeah.
it's move
Yeah.
sideways,
Right.
S&P goes down another one, they're
Yeah.
gonna go down, they're gonna lose
Yeah.
all that money they put in there because it's a part of
Yeah.
the trend.
So my issue right now is that I'm stuck between this is like a great buying opportunity, or this is that inflection point to further downside. I'm stuck right there. It's the typical fear that every investor will feel when markets reach this turning point.
Absolutely.
And I don't know. And it's nice to have a community to kind of see what
Well,
you guys
what
think.
you said also
Well-
was that a lot of analysts are projecting next year in the April, May, June, there's a probability of more of a significant decline.
Yeah.
So of
yeah.
course people are thinking, well, maybe the decline is starting to happen now,
Yeah.
right?
Yeah.
So
So
Wednesday, Thursday, Friday.
yeah. So here's an example of S&P 500 GAAP earnings, not non-GAAP.
Yeah.
GAAP means it's following a very strict accounting principle.
Right.
When you hear non-GAAP,
Yeah.
that's kind of like, what the heck, man? Like, we don't know what you
Yeah.
might be like fluffing the numbers
No,
somehow.
that's right. It's
So
true.
this is the GAAP quarterly earnings. So the orange is the current one, and the pink is the forecast, and the purple is the realized actual of the previous, right? So yeah, earnings has been going up as long as printing money keeps happening. But when printing turns the other way, interest goes up, right? There's many different pressures that could affect this. This is the forecast.
It's just hard to read again. Here, let me just adjust.
Oh, it's just dates. Oh, okay, yeah, I'll explain it to you. So you're looking at 2018 quarter 3, 2018 quarter 4, right?
This seems to, wait a minute, oops, sorry.
Almost, yeah.
There we go, okay.
Different meetups alternate between. Yeah, not if a broader market sells off. So yeah, that's a comment made by Dar. So yeah, this is the gap numbers right here. So let's see. I mean, if earnings keeps pulling through, yeah.
So that's projecting that in the fourth quarter of 2018, it'll continue to grow, but then a big decline in January through March of 2019, which would be nasty,
Yeah.
right?
Yeah. Well, not really a decline, just sideways consolidation. What this is telling me is that, okay, earnings pressure is good, so that's bullish, but interest rate and global macro pressure is bearish. So 2019, I'm going to tell you, I won't tell you direction, but I'll tell you volatility is going to happen. Because we got two directional fighters.
Yeah.
So that's what I'm anticipating for 2019.
What's the
And,
source of that? What is that?
This is the source of, so a money manager I follow, and he pulls it from a database.
Oh, I see.
Yeah.
Real quick on GAAP earnings, though, what happens is S&P is gonna go ahead of the GAAP earnings, is gonna start to fall crazy, and then GAAP earnings is gonna follow. So it's always like that, S&P is gonna do like about
Yeah.
weeks before.
I
it's
think,
gonna
yeah,
start to move
price
forward.
price will move first, and then earnings will reveal
I'm
itself.
gonna put up a chart S&P 500 with GAAP earnings, so you can see exactly what I'm talking about.
Yeah.
What happens, S&P starts to go down, and then GAAP earnings follows right.
Yeah, so the private ocean money manager, or wealth manager, he focuses on 20% off the top. His risk management system is technical by nature. He's not using fundamentals. He's not waiting for earnings to turn. He's waiting for 20% off the top. That's a technical technique, right? So someone who's managing 800 million is using that technique.
I see, yeah.
Yeah. So you just have to forecast it, right? Remember what I said at the beginning earlier today? The best stocks to buy is not when the PE is low. It's when the PE is negative. The best stocks to buy is not when the gross margins are positive, but when it's negative. Because no one's looking. No one's anticipating it will go positive.
Oh, I see.
No
yeah.
one's anticipating this is going down. Maybe that's the best time to short. It's the same. Because, I mean, I'm able to, I guess, forecast a little bit more because I kind of understand the global macro picture. And I'm seeing other economies, DM economies, developed market economies, starting to tank as well. And so that's a little concerning. And I'm seeing that as spillover on top of high stock prices, leveraged companies, rising interest rates. So this time is a little bit different. This time there's a lot of components of the hurricane versus like, oh, 200-day S&P 500 in 2015 hit the 200-day moving average, broke down. But you got other economies still going up. So I think it's still holding up. But now you got a confluence of everything, and things are kind of piecing together. And so I don't know. A lot of very credible people I follow and pay for their services, they're saying second half 2019.
Second half what?
Second half of 2019 as a major turn.
Turned down.
Yeah, turn down.
So if it had a major turn down.
Felix Zulauf, a billionaire money manager. I really respect that gentleman.
But that last graph though, of earnings, right, usually would correlate stock performance on fundamentals. So if that graph was correct, then you couldn't really go wrong investing in any company with solid, profitable growth overall.
Yeah, so I'm not saying everything is not an opportunity.
Right.
It's just Apple's not disappearing. It's just gonna get cheaper. It's just if you're buying in right now, it's gonna get cheap in a way you're not, happy with.
Yeah.
But looking at just from all the indices, right? Maybe we could be setting up a head and shoulders. You never know. There might be one more rally, one more leg up in this game, right? But it's starting to look like it, right? If you guys are familiar with head and shoulders, and this is the monthly, by the way, right? This one just went down. I think this one needs a retrace. So, yeah, I mean that's what I'm seeing, guys. Now I remember I told you about the DAX. The DAX is already sporting a head and shoulders right here, and so European markets are already confirming downtrend to me. American markets and Nikkei markets have yet to confirm to me, but I already have confirmation over here. Not confirmation, but one extra data point. Okay, I'm measuring. You guys are starting to see like this guy looks at a lot of data points that I should automate somehow. But yeah, that's what I'm seeing in Europe. So now, how can we further confirm this? If we see that Europe and DAX, two major economies in Europe, are going down, is there evidence that the dollar's rallying? Because you're exiting your economy running to a safe haven currency, right? And then if when I see the dollar rally and gold rally, that's when I'm like, okay, this is a pure signal right here, because it's like you're running to a safe haven, but another group of money is running to an alternative safe haven, gold. So it's like, whoa, double whammy right there. We'll see. We'll continue to monitor. Where did we go? Where were we? We were looking at top players, right? The top players in the stock market. I kind of like lost where I was. But yeah, Microsoft down 9%. Amazon down at 1.25%.
Is that for the day, for Friday?
Not for Friday, but from top, from the high.
Oh.
From its highest ever.
Highest ever.
And then, yeah. Google, down as well. So
No, that column changed though. Is that for Friday?
no, just the biggest one as of Friday. The biggest players as of Friday. Microsoft
No,
number
the
one.
column, that change percent, is that as of?
Oh yes, as of Friday.
As of
Friday,
right.
Microsoft went down
Yeah.
4%. Amazon, 4.12. So if you want to see performance of these indices over the past quarter or year to date, Microsoft's still up, but year to date, Apple's down.
I'm putting
That's
up
right.
the gap with S&P chart up, so you can
Yeah.
take a look and see what.
Gap with S&P. So now he has the earnings with the S&P. So earnings is gold, I'm guessing.
So
No.
no, the S&P is the gold.
Okay, so this is
earnings
S&P
are
and
the
this is
So I
the
just wanna point out, you see how in
earnings.
2000, how the S&P peaked
2000.
right there, and then just about a whole bunch of weeks later, the gap earnings peaked.
Oh, it kept on. So earnings kept going up.
Yes.
Okay, I see.
And the same thing in
Right here.
2008, right? We
So
got a
2008.
51 peak, and for another 4 or 5 weeks, the earnings kept going up, and then they both collapsed, followed S&P. So it always happens that way, right?
Yeah. So I guess we could confirm in this group today.
Yeah, because S&P
Earnings
gonna-
is lagged, which is expected because that's how all
S&P
stocks
guys are making
perform.
money on the past.
Yeah.
S&P is gonna be looking at projections,
Yeah,
all the
yeah.
companies.
Yeah, they behave on like
Yeah. And that's
future
what I mean,
performance.
is gonna that's just how it's gonna happen always,
But yeah, we'll see. It's a process, right? A downturn is a process. It'll take some time. This one looks kind of scary, so we'll see. All right, it's funny if you do 20% off the top of this one, it'll be like right here, right before this major dip. Kind of interesting.
And let's not
Well,
forget
why don't we
the
calculate it?
right?
1561 times 0.8. So at 1248. 1248. 1236. So right here. Right at 20%. Money managers or wealth mutual funds who manage the mass majority of money, I guess liquidate right here. At least they're following that same rule.
Yeah.
So I'd probably be preparing at like 20%. It's like, oh no, indices are starting to hit 20% off the top. I better go buy some put options. Some like setting up some ladder put options from like weeklies to monthlies to.
And my point is, if you want to fix yourself, get above the 50, maybe fix yourself, and everything will be okay. But if you don't, this is what's gonna happen.
Yeah. So in another way of saying it, the price action is hanging out at a level I'm not comfortable with, and but still I can't predict the future.
No, of course.
Yeah, it's just it's very fearful as of right now. So this is a glimpse into earnings. Did you guys want to finish this, or you want me to go through it a little bit quicker? Because I know this might be a little boring. Because we got 30 minutes. Let's see.
What else was on your agenda?
Just pretty much review this, talk about some stocks, talk about gold, my gold portfolio that I'm bullish on for educational purposes only. Did you want to see that? We looked at it earlier.
Yeah.
So these are like the top gold securities that I'm kind of eyeing.
These are miners?
Yeah, gold miners. Not the juniors, but the majors. So I think this one right here, AEM, will be a institutional favorite. Right? So now keep in mind, like we're buying gold to hedge the market volatility, right? Keep in mind mutual funds and institutional money managers will need to buy as well. And when they look at the gold sector, they're going to buy the best. They're going to buy the apple of the gold miners. They're not going to buy first like the bottom end, like the AMDs of gold miners. They're going to buy the apple.
Yeah.
Yeah. So I think AEM is an apple. And you could tell by market cap. You could tell by a lot of things, right? If I were to just filter it by all gold, number 1 would be NEM, Newmont. Number 2, AVX. I'm looking at number 4, AEM. Right. So these are some of the. It's interesting how this club transitioned, right? We went from talking a lot of like stocks, momentum stocks, tech stocks, software stocks, semiconductor stocks, and then we kind of slowed down and started looking at global macro, and then now we're looking at gold. So that's kind of like the trend that I'm transitioning to.
Well, there's only so much money you can put in gold of your own portfolio.
Yeah.
So what
yeah.
else would you do with the rest of it if we really are going into a bear
Yeah, I've been seeing some interesting niche services, right? So there's this company in SF, and it's weird. They'll buy partial home equity, meaning like let's say you own 100% of your home, right? They'll offer you 20% at current market price, and I gave them a call, and I'm like, hey, I'll be an interested investor. I wanted to hear more about what your services are offering. Like, who are your investors is what I want to know. And they say it's institutional investors. And I'm like, why would institutional investors want to buy like at like such a peak and buy 20% of your home equity? Meaning like if your home goes up another 20% and you want to buy the equity, you got to buy it from the institutional. So is it a quick trade, or like what are you doing with this? You're constructing a portfolio of yes residential real estate, but you're buying the upper end. So I don't know. It's a niche service that's kind of
Is
like.
that REITs?
No, it's not REITs. I forgot the name of the company. I would have to circle back with you. I gave him a call because another gentleman asked me, like, hey, this company offered to buy my equity, like about 15 to 20%.
All right, that sounds really shady. What
Yeah,
else?
I don't like it either.
But it's backed by institution. Now that's like from our point of view, from like let's say a homeowner's point of view, that sounds kind of attractive because you get to liquidate 20%, not the whole thing, right? If you feel like it's topping, maybe you can liquidate 20%. But who knows? Because I think in the next, so this is my opinion. If we have a downturn in the next money printing environment, every real estate will go sky high. Would you guys say that's a fair
Can
statement?
you repeat that?
In the next printing cycle, I think real estate's gonna go really high.
Can you explain that?
Yeah.
Okay. Now I see where you guys stand. Did that make sense to you, or?
Well, basically, I think what's gonna happen, we're going on a downturn, right?
In the next time they lower interest rates for a long period, yeah.
What's gonna happen basically, it's gonna put a lot of pressure on the Fed, and the first thing they're gonna do is they're gonna stop doing anything to the rate, right? And they're gonna let's see how the market goes down. If it keeps going lower and lower and lower, of course, real estate prices are gonna go lower.
Yeah.
Now, like you said, if they start to print money again, like another quantitative easing,
Yeah.
that's gonna put a stop to whatever's dropping. It's
Yeah.
gonna stabilize it.
Yeah.
And then if they start to print more money, then we're gonna get your move. I'm just saying we're far away from that because the Fed is gonna have to make drastic changes. Right now, they're barely going to one increase. They're gonna have to go to 0, and then they have to get more. So when are they gonna do it? Is it gonna be a 30% drop from here on S&P? Is it gonna be a 15% drop?
Yeah.
Or are they gonna wait till it's 40%? But when they do it, you're right. But in the meantime, until they do it, they're gonna go down very quickly.
Yeah, I feel like in the long run, let's say 100 years, every asset price that's fixed will go up. If the sovereign system still exists, meaning if that sovereign still exists, because they will devalue the currency as much as just because they have to.
Right, if they're gonna print money, and then also they're gonna do what Japan did and start buying stocks,
Yeah.
they're all gonna go up. you know, but I'm saying they're not gonna do the extreme situation until we get a major.
Yeah. It's really interesting because it's kind of like a snake eating its tail.
But it works.
Yeah, but it works. Because let's say you know like a snake eating its tail, right? You're about to die, but it works in the short term. It's delays the death, right? Because you're like, oh, I'm getting energy, but I'm killing myself
So
slowly.
that delays like 10 years delay, you know?
Yeah, it's kind of interesting. I never thought about that.
Can I ask a question?
Yeah.
That whole Brexit thing you mentioned about a vote coming up and so on. So whatever the outcome of the vote, how does that impact the fundamentals of the Walmarts and the Targets and the Amazons and the whatevers?
Well, this is what happens. So basically, Brexit's gonna have a vote yes on Brexit, no on Brexit, right? That's the first vote on Tuesday. So let's say they get something, the worst case scenario. They say no.
No.
They're gonna have a hard Brexit, right? Which means they're gonna get out next year, no matter what. Then what happens is people lose confidence in the European Union, and then everybody starts to sell their stock, German, France, Italy, and then what happens, that's basically a contagion to the rest of the world economy, and then the whole world economy starts selling the US, and it's just a contagion problem, right? It's such a big problem worldwide, and we're interconnected, so it's gonna be a contagion problem to us. And that's when you see that kind of mess, we go down, another 500 points in that Dow, because we're having problems with the European Union. So it's a contagion problem. And that, of course, affects us, Walmart, everybody else.
So wouldn't it be the reverse though? I mean, if the European stock markets are at risk and such, doesn't that make the American markets more appealing?
You would think that you would get money from euro go to us.
Right.
But it doesn't work that way because the confidence gets hit so bad that they panic and they go to gold, they go to US treasuries, they go to silver, they go to cash. It's more of a panic. If it's a minor thing like, like a little Greece or something, that's not, take some money out and go here. But if it's a major, one of the top three, like, the big one is Germany, second is France, three is Italy. For one of those big ones, they're gonna panic, they're not gonna go to any stocks, they're gonna go to gold.
To cash and gold.
Yeah, all of that.
So I personally,
sense.
It's a contagion problem.
from what I know about the world now, I prefer USA assets, hands down, because it's like it went through several refining periods. Like every crisis, central banks did the right things to like fix the financial system. So I guess we won't go through the whole entire thing, but the report, it'll start to tell you that financial institutions right now are in the best shape ever. They could handle a liquidity event, right? Central banks and financial institutions. So the whole stress test and stuff. Their balance sheet shows that they have the reserves to handle it. So it just seems like, wow, like now that I'm learning more about financial history versus the rest of the world, like China, emerging markets, sealing off the economy, printing like crazy. Well, versus USA, printing, like intelligently, but also making sure everything works. So I just feel like in the long run, USA assets are the way to go. And in the legal system, don't forget the legal system, right? Because when we were doing the China analysis, the whole Fan Bingbing, put into jail. What was it, last Friday? Another someone from the CFO of Huawei. I don't know the story on that, but that sounded interesting.
I can tell you basically what happened.
Yeah.
Canada arrested the CEO of Huawei, which is basically
China?
The daughter of
from
the
China, the
CEO.
daughter of the CEO of
Yeah.
China, she's the CFO. So they arrested her because they're saying she conspired
Yeah,
to do
yeah.
some things with
So-
sanctions. So China's really upset about that. They're saying you better let her go
Yeah,
because that's against her rights.
yeah.
And they didn't let her go on the weekend. On Monday, they have the hearing continues. So China's gonna retaliate against Canada in a very serious way if they don't let her go.
Yeah.
And then the US wants to be extradited to her, so she can, so that basically throwing a big wrench into the US-China relations to the trade war.
But in 2 weeks that whole thing's gonna be irrelevant, right? It's just gonna disappear.
It probably will, but it's still gonna have some damage short term
It-
as far as their relationship.
It might. So I view it. It might be irrelevant, but it hints to me how the sovereign operates over there, and I don't like that type of instability versus our sovereign, how we operate. Yeah, we print money, but our legal system is like really nice. So that's just a little taste of what I heard. So I'm going to replay that scene. I'm not going to
More
go
money,
deep into
intern-
politics, but I really like this scene. And,
But
and
more-
to me, just listening to it a second time really educates me.
What was so compelling when I met
So
you,
what I'm going to show you is the rate of how China's printing money compared to the USA printing money, right? And whenever you print money, you should expect growth, but they printed more than what growth. Yeah. So listen to this. Pretty interesting.
the most compelling thing that you showed me was the chart of Chinese M2, the moving graphic.
Yes.
And we'll provide that moving graphic to the Real Vision audience separately in this video. But more importantly, Chinese M2 has grown from $1 trillion worth of RMB to, as you say, $30 trillion on an economy of 12.
Yes.
They've printed more money internally than any one country in the history of the world as a percentage of GDP, and as a percent, as call it M2 growth versus GDP growth, nothing has ever come that close.
Yeah.
So they've created a false economy of RMB and the exchange rate in dollars. So you took us to another place. You took us to
So that's the chart I wanted to show.
dollars worth of RMB
It's very interesting.
to, as you say, $30 trillion on an economy of 12.
Yes.
They've printed more.
What'd you say?
Want to see it again.
You wanted to see again? I just closed it out. Yeah, because I couldn't pause it. So
How the real estate price goes so up in
Yeah,
China right now?
exactly.
Reason that
Eh.
no money should be spread to the market since it will cause a whole bunch of inflation. So it must stay in real estate. It could be compared to like last 80, Japan, and then they go they just went to 20 years two decades degrade say the bear market.
yeah. So oh man, I lost the video. So yeah, that to me is extremely interesting. Like now I understand that their bull market was super artificial.
Yeah, and compared to here, the free market is that China still are able to control the real estate price. It's not letting it go up more. It's not letting it go down a lot
Yeah.
at a certain time.
Yeah.
But it's just very hard time for China to deal with that big printing out.
Yeah. And so me hearing about all these Chinese executives getting arrested and stuff, it's kind of like, this makes a lot of sense because if your economy, you're a Chinese, you're trying
Took us to another place. You took us to Hong Kong for a minute.
your Shanghai index is down like 25%, 30% on a year. You're in a bear market right now, right? So if the index is down, everyone is stressed, right? It's just like how if our stocks were down, we'd be all stressed. We'd be in a
So
bad mood.
does that make China more likely to want to negotiate with the United States?
So if it's down like that, people are going to get mad, and then people are going to start doing research. And if they start doing research, they're going to find out like, oh, they printed money, and this is why this gentleman, the billionaire, thinks a revolution is coming, right? And then now I'm hearing like all these stories about these executives getting like put into jail, like they're trying to hide something. So that's why I really appreciate the USA system because it's like the legal system's legit.
Absolutely.
I don't see like we're playing fair. And we're keeping that system going. So if we keep that system going, we keep printing money, then I think in the long run, all USA assets would just go up. I mean, yes, right now we're kind of in a corrective, we need to correct because we're overvalued. But we're going to go, to true value, whatever, real value, and I think it's going to appreciate in the next printing cycle.
I would like to mention that special day on, I think Wednesday. After Wednesday night, that news broke out, and I was just started focused on that part. And I assume
You talking about arrested in Canada?
Yeah, arrested. And I assume that Thursday, the stock market in the US will just go down 700 points for the Dow Jones, DJX will go down another 700. But no, at the middle of the market, it went back from 7.09 points down to a little bit. Yeah.
But you know why that happened, right? Because the Federal Reserve came out with a statement saying that they're thinking of not even raising rates in December, and they may do it in January. That's
One thing is
That's
that,
more material than the rest of a CFO in Canada, right? Like, who cares?
but
in
another
relation,
thing,
yes.
when people are doing the analysis later, aftermath, they found out who are those stocks that leading the market going back from 700 negative. It was real estate. And it was real estate.
Real estate?
Yeah, real estate. Yeah, that's
But they all came back, even like Walmart, everybody came back.
was-
But in relation, the real estate came back
They
more.
started from the downfall. So at first 4 hours of the stock market, every stock was went down heavily, but real estate company has already from the lowest going up all the way till the end of the market. So that's what you mentioned about, you mentioned about the real estate company, are they going to have a higher price? I think, yes, that's the start point. But I don't know, I don't have too much detail.
But that's
Well, I mean,
determined
they live in a, it's, okay, it sounds like, correct me if I'm wrong, they live in an economy where the sovereign could take their assets. The CCP could take, the government could take the people's assets, like Jack Ma. Is that correct?
Let's see, I don't
Yeah.
know.
So it's,
Okay.
so if they could take your assets, then it's kind of hard for that upside benefit, you know?
Yeah.
So I don't know, I'm not, again, I'm not a
So
sovereign
every
expert.
Chinese are likely to share some of their rights, actually. Not all of them, but majority, historically, would like to share some of their rights to the authority.
Did
To
you,
let them control something.
So
So it's
wouldn't that,
totally different than.
so wouldn't that make companies that have high exposure to China more vulnerable, like McDonald's? High growth in China is part of their growth and valuation. So wouldn't it mean that if China's going sideways or down, that it would take McDonald's or any company that has huge activity in China with it?
The key is huge, right? They only have 5%, it doesn't matter. But if they have like 80% of their business in China, of course, right? McDonald's doesn't have that. McDonald's is expanded in China, yes, but it's just such a minor, if you look at the percentage overall, they're worldwide, right? So
I
China's
heard
not gonna
a
affect them.
rumor that China may have a comeback strategy that just force the government or government-related agency or companies not buying Apple's product for this event, for always event.
But
It's
the
just a
problem,
comeback.
yeah, but the problem is that Trump will, if he does that, he's
Still,
definitely gonna
yeah,
increase to 25 billion.
I would still say
Yeah.
Trump is a very good president
Yeah,
for
right.
this foreign issue.
And I think that Trump basically exposed China to, they're not as strong as they think they are.
Yes.
Because they're completely just bullied them like crazy. They stock went from 53 to 38 on the ETF. And then their ETF for China went from 53 bucks to like 38 bucks.
The ETF of China, can you explain that?
FXI, right? It's just the
just,
China ETF.
it's an ETF that tracks the Chinese index.
Chinese indexes
Yeah.
compare,
So they
okay,
went
got
up
it,
like
got it.
30%, and then, so basically China's trying to fight back, they can't fight back because he's so reckless that Trump will just, 25 billion tomorrow, he'll not only do that, but do the rest of the 50 billion. And then they're waiting for China to react, and they just cannot, they're not reacting, and I don't know what they're gonna do, basically, I don't know what they're gonna do, but Trump is just so aggressive, it just exposed China that they're not as strong as they thought
Since
they were.
this is a great time, why I will say that?
What is a great time? For what?
For what you guess. So I will tell you further, you will know what is a great time for Trump to fight China.
Okay.
Because starting from 2014 or 13, China has already aware of this problem. So a soft landing term was using in an economy so widespread. Soft landing. China knows the inflation, wants to have a soft landing so that economy doesn't crash. So the financial is going like that. Trump can identify that, saying, okay, if you are going down, don't go down like that soft. We go down immediately. In this case, definitely other entities in the world can get the advantage of China's kind of economy. So that's why I mentioned the point. Soft landing. So they started doing one belt, one road, whatever strategy to invest more and make their currency into other countries to relieve their economic stress. But with Trump's
But I'll give you one example what Trump did, right? He told China basically, I'm gonna put 10% tariff on your stuff of X
Yes.
billion.
Yeah.
And if you retaliate again against our grains, it's gonna go to 25 that day.
yes.
And if China, of course, they wanted to, they didn't do it, right?
They won't.
So now it's like they don't know what to do. Are they gonna be long-term and basically let the US go 25% like they did and then see what happens? They're gonna start doing
They
it
will
now.
still
So
do
I don't know what they're gonna do, but
They
it's just.
will still, keep letting Trump do whatever and trying to make alleviate it.
But what about March 1st, right? March 1st, they go from 10 to 25 that day.
Yeah.
So are they gonna make a deal before then or not? It's like, I don't know. what's
It's
gonna happen.
already that much to be cut off, and for the consumer in the U.S., it's a major hit. But for China, it's it's already a great hit.
But it's gonna be a lot more if it goes to 25 from 10. That's
So
a
that's
big
why,
amount.
yeah, but if China goes down, it's not good for the whole world's economy, still.
And what Trump is basically saying, you're going down, I'm going down, let's see who's gonna, you know,
Yeah,
who's
it's
gonna do
still,
better for both
from
of
the
them.
very beginning, it was like this kind of argument, ongoing, but.
It's a very serious situation.
So to kind of close it out with like 10 minutes we have left.
Sorry about
Hey, no worries, no
you
worries.
guys to train us easier.
So-
Well, that's a fascinating topic. Thank you for sharing that. That's really
So
interesting.
I mean, I have my own copy of the Federal Reserve report. I could pass it around. But the last part I want to point out or talk about is the near-term risks to the financial system and what they see. You can take a look. I'll pass it around. I highlighted what I feel by the numbers. You'll see number 34, 35. These are great points to kind of just skim over if you want to see.
Can you boil it down to a couple sentences?
Yeah. So into a couple of sentences, near-term risks that the central banks see on top of asset valuation and all that other stuff. China and emerging market risks, right? The activity over there, the bear market in China, that's one key thing. And also dollar rally causing emerging markets to go down. So a lot of spillover effect. That on top of what's going on in Europe right now, Brexit
That's a
and
big one.
Euro area risk.
That's a big one.
That one's a big one because it's a DM risk, right? It's not an EM risk. DM is another level up.
Asian
And then
worldwide.
the third one is increasing trade tensions and geopolitical uncertainty. These are the three things that they feel are major risks.
Okay, so the Brexit one. Let's say the Brexit deal
That's
doesn't
not
happen.
only the Brexit, but the whole European Union with France, right? All of the end of voting that's happening next year in June, with the entire European are going to the polls.
So what's your thought?
Italy's, how to say it?
Italy's got the budget problem,
Budget
they don't
problem.
agree.
So the Brexit exit. Let's say it doesn't happen. What do you believe the implication will be?
Well, I mean, there's gonna be, it's just not yes or no, right? Because it could be that it doesn't happen, but they do another schedule for another vote in a year, right? That's gonna
Okay.
appease the markets, maybe in a year they're gonna say no, right? So if it doesn't happen, it's a hard exit, what they call it. Basically, it doesn't happen, there's no scheduled vote, they're going on January 17th, whatever, on a hard exit, then all hell's gonna break loose, right?
What do you mean by all hell will break?
All hell breaks loose basically means that there's currency's gonna suffer. It's such a big mess for the European trade union because they don't know what's gonna happen, what they're gonna do with Brexit. There's no rules, there's no nothing. And then Italy and France have started to panic. They're gonna say, hey, if you can't deal with them, I don't wanna deal, I wanna print my own money. There's a big problem with the European Union, they cannot print their own money, right?
Yeah.
So they basically got 19 nations got together and said, we're gonna have the ECB control the money supply. Like us, we get into problems with printing our own money, right? Italy gets into problems, they gotta go begging to the European Union saying, can you please print money for us? They go, no. We got rules, we're not gonna do it. So that's why they got unemployment at 10%, they cannot print money and fix things. So France cannot do it either, they have to go to the European Union to ask, please print some money, buy our bonds. We're gonna buy this amount of bonds and that's it. And then they're stuck with a 10% unemployment, people suffering, they gotta raise their taxes. So that's the big problem, the European Union does not print their money individually, and that just creates chaos, and it's just gonna be something that's gonna have to end very badly because they wanna print their own money, because they have to do it, right? And when Greece wasn't doing it, who cares? They gave them a loan for 80 billion, that covers you for 10 years, get out of my face. But when you got $1 trillion problem with France, which is the second biggest in the world, you cannot do that. It's gonna be chaos.
Wow. So what you're saying is that badness in Europe has a direct impact on the badness in
That's what I'm
America.
saying, number 2 is the monster thing, it's a
Wow.
contagion problem. You'll see it develop as it happens, because that's a big problem.
Any thoughts? Well, it's a fascinating topic because that's.
Well, what I know that all my thoughts usually I used to think a lot about what's going to happen on global scale. And every time I positioned myself in my portfolio for this event, and guess what? It didn't happen this way.
Yeah.
So I just stopped speculating what's going to happen.
Yeah, because you've never had anybody exit in the euro, right, ever. So why would you worry about, you never had the number 2 country in the European Union, which is France, getting into almost a revolution, right? So of course, why would you worry? You had little things like Greece, which is the size of Wisconsin, who cares, right?
Yeah.
But when you got one of the top 3 with problems, you gotta start paying attention, so.
Yeah.
Of
Well,
course they pay
let's say,
out.
what are implications for the market? Or let's say 80% of your money in dollars.
You're talking like if France wants to leave the euro.
Okay, so
Okay.
what's the implication
The
for us?
implication of
For
the
your
market is
portfolio?
gonna be, you got the second biggest economy in the world, which is the 19 country ECB all combined, which is almost as big as the US, getting into chaos, and that's gonna create worldwide panic, and it's gonna spread all over the place. That's the implication.
Right.
And all the markets go down 10 to 30%.
Okay, what do you do about it? So you know that it might happen. What do you do about it?
You go to cash or you short the market with ETF versus
But,
ETF.
but you don't. You are sitting here and you still have your portfolio about
No, you
200 moving average.
Yeah, it's below already, yeah. So that's what you do, right? You make decisions.
What I'm trying to say that you made up your mind about certain kind of course of events in the future.
Yeah.
So what
There-
did you do? So you say that we can have this scenario.
Yeah.
There are other scenarios. So to me as quant player, okay, I have 5 most probable scenarios. So I'll try to optimize my portfolio,
Right.
my holdings, for according to this situation. And every time I see evidence that something changed in some scenario becomes more kind of.
You gotta make your own decisions. I'm just telling you a scenario, just pay attention to. Where if you're blind to it, what's the point? You don't even have it in your calculus. At least have it as a 10% calculus to the rest of it. I'm not saying let it go 99% of your, it's just gonna be on that. I'm just saying pay attention to one input. And if you don't have that one input, then what do you have, you know? I'm not saying make a decision on when France is gonna get out of the euro. I'm just saying have
Well,
your input and
so-
start paying attention.
May I ask you, what was the situation, let's say, going back to a really good kind of what happened in the market in the financial crash? Let's say we are talking about year 2007.
Yes,
How did you position yourself? What did you do?
same thing. If you start to, if the 200 and on the monthly chart, if you start going below the 20 MA, you go to cash, right? And then after that, you wait until it gets above the 20 MA on the monthly, or if you use on the weekly, you use the 50 MA. And if it goes above the 50 MA, we don't have this conversation.
I
The
totally
world
agree
is
with you.
fine.
I
There's no
don't
problem.
agree about the view, but so you didn't think really about, okay, here is this Norwegian, or I don't remember, Dutch sovereign fund, which kind of lost enormous amount of money on derivatives. You didn't think about it.
No, you still
The only
think
thing
about
you did,
you
you
still
just-
think about Lehman, you think about everything, but you just also have the position that we're below the 50, so those problems are gonna be even stronger on the downside, right? If it was above the 50, I don't really pay attention to the other stuff because it's not a problem, right? I start paying attention to things when we get below the 50.
Okay, I very agree with you. So what I'm trying to tell you that there's so many components kind of contributing to the future directions of
Yeah.
this and that and everything. And JC is absolutely right. So here is the market, and here are a few indices. So you watch the behavior of the indices. Because this is kind of sum up of
Yeah.
what's going on in the
Yeah,
market.
exactly.
It's like physics. There are a bunch of forces,
Yeah.
but at the end, all they kind of move this index.
Yeah,
And you
yeah.
just watch where it moves. And you really don't care what happens in ECB, what they do
Yeah,
in Greece, Italy. Well, if you really want to play some specific game, let's say you want to play Greece against Italy, whatever. Like,
Yeah.
so you pay more attention to their.
Yeah,
You're
You're right, you're right, you're
Everything is priced in, and everybody's got their opinion on how much value you're gonna hold to a specific topic. Like to you, maybe the European Union is a 1% thing. To me, it's like a 15% thing. Everybody's different, right? So I'm just saying, just think of it as an input, and you said your input
So-
of 1% or 20%. I'm just saying that's a big one that you guys gonna, later on we'll know how big it was, right? But I'm just saying, it's just an opinion. I just think it's a big input that we gotta do. And people may say that's nothing, 1%, which is, they could be right. We'll find out how the market.
so I think by this point, you kind of know, most of you guys maybe know how I kind of invest or trade already. When times are good, like 2017, or just like things are calm, I pick the great stocks that I think are going to go up. So stocks like CyberArk, Fortinet, Splunk, Workday, like these are, Salesforce, these are software companies that actually put in due diligence. But in this environment, when indices are pulling everything down, and indices in other major markets, DMs, developed markets, are pulling things down, I can't operate my model that I always play. So now I have to transition to like, okay, what's going on? And I start reading, and it leads me to gold. Because it's like, okay, there's a lot of underlying reasons to go to gold. So someone who's primarily a technology momentum investor or trader, I'm now looking at gold because I'm looking for opportunities. That's all I'm looking for.
And I'm looking at you because I'm putting gold in my portfolio like for the
Yeah.
last 25 years.
Oh, no, like,
Well, it always was part of my portfolio.
Yeah.
And in average, actually, I lost money with gold.
wow, yeah.
That's
So
what
so
happened.
the other thing
As
is,
of today, there were times where actually it really kind of bailed me out from very serious trouble.
yeah.
But as of today, if you kind of think what happened in the last 25 years, probably I lost some money overall.
Yeah.
But I
So
think like
depends
But
on
this was insurance. gold, I never put money in gold as speculation. That was always insurance stuff.
So if you had Microsoft stock, which is one of your favorites,
Yeah, that's,
which I don't
that's
have,
my number
you-
one favorite.
You might be inclined to move some percentage of that into gold or cash on Monday, let's say.
Yeah.
Assuming that the stock market is going to go down another 2 or 3 or 4%.
Yeah, yeah. But I'm primarily options.
Oh, options. That's right.
I go options.
Unfortunately,
So-
with gold, people like JC in charge. So once gold starts moving up, it will be humongous move. And the more it moves up, the higher it goes. But until it's about 20-day moving average, 50-day moving average.
Once it clears all of those,
I just see rubber bands slowly tightening every day, and I know it's a rubber band.
I hope so.
I mean, I try to give you guys the best insights I can, but I don't forget, I myself am learning too. I'm approaching this from like a very humble perspective. I'm not like you know,
You need
like
a crystal ball. Where's your crystal ball?
it's fuzzy, man.
No, that's why I come here. I mean, it's a crystal ball. That's what's going to happen to Microsoft on Monday.
Yeah. Hey, but you know, if you guys find like a clear crystal ball, let me know. I'm always on the lookout
That's
for that.
great.
Yeah, usually people refer to Warren Buffett like a guy with crystal ball. I don't remember that.
He was in a losing period too.
Yeah,
He's
well,
Wells
actually,
Fargo and
that
Apple,
was he
too.
was just lucky because he had a period when he lost more than 50% of his fund. So he was just got pure lucky. There was another Warren Buffett who wasn't this lucky,
Right.
and that another Warren Buffett actually lost everything,
Yeah.
and we don't know about him.
Yeah.
People think that real estate is a safe place to put some money, or? you think
I could show you real estate over here. So I have a map.
Thanks, Pat.
Hey,
You have a meeting next week?
yeah, I'll be here next week, guys.
Okay.
Uh,
Thanks for sharing that.
Nice talking with you.
Oh, absolutely.
Yeah, we track the real estate market as well. There's an equity built up. So I mean, it's not a bad spot, but if you're leveraging, right, then that could be something. But I'm more of at this moment, I'm looking at it from a transaction perspective, where I make money from a transaction fee, whether it be real estate wholesaling or real estate agent transactions, whatever. But position-wise, I don't know. I'm not too of an expert on that. But we look at what you were here when we were talking about commercial real estate, right? Interest rates are at record lows, cap rates are at record lows. Commercial real estate prices are higher than 2008. In that one chart, I can show you real quick. So this is from central bank's view, okay? And I think that view is better than my view, but let's see. It's in the report that I was passing around. So we'll end it with this commercial real estate nugget, and then we'll call it a day. Is that okay? I don't want to hold you guys too long because it'll get boring.
Just get tired.
Yeah. You'll get worn down looking at this stuff all day.
Enjoying this kind of discussion too.
oh, really?
Yeah.
Yeah. So this is the. Oh wait, no. Where is it?
I just got some assignments from my class, and
Oh, I see.
I just want to gather some of the conference meeting pictures.
So for this. So I can't find my own work. Okay, so this is the commercial real estate right here. So on the left you have commercial real estate prices, and then on the right you have the cap rates. Right, cap rates are at a record low below 2008, and prices are climbing above now. So that's the current picture. And I would assume commercial real estate is a lot more efficiently priced than residential real estate. Meaning maybe residential real estate adds more premium, emotional premium, versus like commercial real estate guys, they're very savvy about their numbers. So, yeah, everything's overvalued. That's sort of the conclusion.
There's
That
a good chance that things will come down before they go up, like we talked about, maybe not,
it just seems like every asset class got pushed to a price point where now the only thing is global macro. You know, like it's based off of what central banks are going to do almost. But I don't know. I'm studying to figure that out.
Last night I read a news that maybe Federal Reserve will not increase any interest rates. in 2019.
But that kicks back into government balance sheet and Federal Reserve balance sheet. It looks shady. That means central banks, if they're not going to raise interest rates.
Compared to the whole world, it's not the most shady ones. It's like still relatively.
I mean, true. Yeah, true.
Yeah.
But either way, they have no choice. Look,
Yeah.
they're in a lose-lose scenario. if you don't raise interest rates, then you're damaging your entity, central banks.
Credibility, yeah.
Central bank, exactly. So then people jump to gold anyways, right? But if you raise interest rates, you put pressure on the system, everyone goes down, then you still go to gold anyways because of fear, right? So it's like, it's ridiculous. That seems like the hot trade right now, where value will appreciate aggressively, I
I
feel.
think 1 week ago, I heard the news that maybe from Federal Reserve or some big guys saying that right now we have already got a time that the currency is even more valuable than any kind of other investment. But I think the gold would be definitely something that this guy didn't include. I think still gold has a future.
So you see this right here? This is central bank balance sheet. So every time they print money, it goes up. Right?
Sorry.
But every time they print money, their assets, they accumulate more assets because they're buying treasuries. If you buy treasuries, your assets go up. Assets have gone up from 2008. Print money, assets go up, and now they're forecasting down if they raise interest rates. Because when you raise interest rates, you're selling the treasuries. When you're selling, you take the money out of the system. You're pulling liquidity out of the system.
By saving the treasury rates will go down. Yeah, I just want to ask a
If you're
simple-
selling, then prices will fall.
Treasury, yeah, price will
Then
fall.
interest rates will go up.
Yeah, it's
That's
a
how
silly question. Sorry.
That's the dynamic, yeah.
Yeah.
So you see what I mean? They're in a scenario where, look, they're already at 5,000 trillion or whatever. If they want to keep buying treasuries, it'll look really shady. They have no choice. But if they lower it, then we get hit. So at this point, they're at a point where if they raise it, we get hit, asset prices get hit, or if they lower it, then they get hit.
Do we agree on
Lose scenario, right?
Do we agree on the 2008 mortgage financial crisis was because that leverage on the financial institute
Yep,
was
yep,
too high,
yep.
so that some of the financial institute crashed.
So
In this case, do we have any indicators saying all these public traded companies has average higher leverage? Can we have some kind of data that indicating?
yeah.
the
So
biggest company?
here's one right here.
I hope so.
In 2008, right? This is a chart showing securitized products, meaning I turn anything into a stock. I turn a athlete into a stock. I securitized it, right? And then if I securitize it, I sell that stock to someone else. In 2008, this product was the hottest product. It was known as the residential mortgage-backed security, a real estate derivative securitized product, right? So, but now we don't have that much exposure compared to 2008. So 2008 was a very, residential mortgage derivative bubble. This time it's like, I'm looking at every asset class that's pretty high. So it's different this time around. Interesting, right?
Yeah, but we might have the similar situation with the stock market.
Yeah.
A lot of companies
Yeah.
took loans, took money from the government and did buyback and everything. And not everyone actually did well with it.
For the buyback, I think it adds one of the ROE sites up.
Yeah.
For the buyback, it adds
Yeah.
something
Yeah.
and makes the ROE
Artificial EPS.
Yeah, I think.
Yeah. Well, it's, good example is Microsoft. You love Microsoft, I understand, but actually I don't like Microsoft.
Oh, really?
Well,
Oh,
so
shoot.
here example. So what did Microsoft? It went the way Oracle and IBM went. So they tried to, we invest some money, we get some loans. Microsoft had terrific balance sheet 10 years ago.
Yeah.
Zero debt.
Yeah.
I don't know how much they have right now, maybe 50%. But actually they bought LinkedIn, they bought something else. So they borrowed money and they bought new income stream. That's exactly what they did. So instead of growing whatever they have,
They actually buy back.
they actually buy other businesses. But how it works in corporate, in big software world, you buy a new business, you run it for 3-4 years, and then it's dead. It never worked other way. No one ever did anything other way. Look at IBM, look at Oracle. Every big acquisition they did 5 years from the moment of acquisition, that's it, it's almost done.
So if we want to make another example, it's
So there will
GE.
be, so there will be something instead of LinkedIn. We don't know what it's going to be. There will be something instead of other,
Yeah.
like Microsoft
So-
bought GitHub, so GitHub is
So
done.
my favorite hands down way of investing is I like to predict next gen technology. So I'm more of a venture capital style of investor, but I don't do venture capital. But I love listening to earnings calls of like software and tech companies to learn about where they see, you know, big data and all that. I love that stuff.
We just don't want to mention the big elephant in the room, that is AI.
AI kind of, that's mostly PowerPoint thing, let's be honest about it. We have machine learning, which is a real thing. And it allows you to do a few things. So it's kind of, you have some pattern, you can recognize it, and then you can apply this knowledge to recognize more patterns. That's it.
Right now in the stock market, it's already data I just still read 2 days ago. It was like 56% of bots running in the stock market. That makes the 700 backs up 700. And another day, Friday, it goes down again.
Let me make a point about that box thing, okay?
Yeah.
Because basically
It's
what
getting
happens,
aggressive.
we have a 9-year bull run, right, where we go up every single month. Nobody complains about the bots, right? The bots are buying because everybody's making money. So now that we overvalue and then we start to go down because we need to get to a point where it's the real value again, now people complain about the bots. I mean, come on. You know, where were the bots when we had a run from 666 on S&P all the way to 2740? No bots. They also have bots going above the 50 and they buying. So my saying is, it's not about the bots. It's just basically it's about the economy and S&P. The bots are minimal. You know what I'm saying? Because nobody's complaining about the bots on the way up.
But in the longer run, that ratio goes to 99% of bots, and our true market investors are human investors are just contributing very little, so that we are out of control.
Because look at 2007, same scenario with the bots there too. What about 1946? Same scenario. No bots back then. What about 1973? Same scenario. My point is the market is in the market, and the bots have some influence, but not as much as people think. Because this exact scenario, I can go back to points in time in S&P in the last 100 years and give you the exact scenarios how it happened. And it happened because the economy slowed and because we have a recession, not because of the bots.
Another point. So let's go back and think how stock market goes up and so on. So new money get created and they get sucked into the market. It has nothing to do with bonds.
By the best players. By the best
What
players.
happens? People give certain direction to their software. Okay, get me in this stock. I have like 2 days and I need this size of position. And bots trying to optimize.
That's how they are doing their job right now, but who knows what's the job for them in the future.
As of today, you know, I go
As
to
of
a lot of
today, they are
AI
still doing the
meetups.
assignments, like, but for the future.
It's BS. Most of the time it's just BS, it's marketing BS. So you have machine learning, you have deep learning, these are kind of real things. And you have like cars, vision, a lot of things based on these two things.
Yes.
But when they talk to you about AI, like GE showed like Turbine and talk to Turbine, this is BS. This is marketing.
He's
So
got a
don't
point.
you think-
I like
Hey,
to say the
hey,
bots are BS.
David.
No, they're not BS.
Too
This is
much
real thing.
overvalued,
They're
yeah.
not-
David, sales has to happen somehow.
Bots don't make decision where to you know, you need to push the market certain direction. Bots don't make this decision.
And not
People do.
only that, if we get big
Bots
movements
just
down,
execute what people decide.
the people take control of those bots. If we get out of control, it's not like gonna let them go like, you know what I mean?
Yes,
They're
since
gonna
we
move the
are
bots out of the way,
will
take
still
control.
control
Like,
that.
it's not, it's about the
They're
market.
just tools, and that's it. They're just tools. Maybe sometime in the future it's gonna be different, but as of today, they're just
Yeah, for short term, we don't get it.
They do influence, but not to the extent that some articles think that, oh, it's a bot. And then what's gonna happen if we go down like 20% S&P, what's gonna happen is the short sellers and the devil, right? They're gonna say, it's the short sellers doing it. The short sellers have been doing this thing even in the bull market. They always do it. They're just gonna be blamed because that's the way things work.
But with that said, it actually creates opportunity for very short-term player. If you see
It
that
does.
feel something
It does.
huge in the market, like flash crash, you may act on it.
Yes, that's how.
So
Because
that's
the trend
what.
is going like that for the long run. That right now it's more volatile or
Yeah,
something.
it is.
So-
very fast market compete. And, yeah.
So 2019, I was thinking of doing more meetups on short-term tactics, but I think for the most part, people like the whole swing and investing. But you guys want to hear more about short-term tactics, like intraday tactics or weekday?
Intraday.
Yeah, there's a lot of theories in intraday that are very interesting. Like the 15-minute opening range, it works. You know, you never heard of the 15-minute opening range?
Is it?
Whatever happens in the first
Defect
15
by the
minutes,
First.
whatever happens in the first 15 minutes, it sets a range, and intraday it tends to bounce off of that.
Oh, I read several graphs.
And then there's also other intraday indicators that like VWAP and stuff like that people use.
Yeah.
So and then like intraday patterns, but they're not as significant as daily patterns, right? Everything zoomed out with more data points is always better than zoomed in. If you're zooming in, you're playing short term, then yeah. I kind of like short term, and I want to do it more now, like I did in college, but yeah. But I'm also aware, like I personally, for me, I want to build out like an income stream, so I'm trying to diversify. Maybe like in the early years, build out like deal flow, and then in the later years start aggressively trading more. Yeah. But hey, anyways, guys, maybe we call it a day. I think you guys talked quite a bit. Yeah. Yeah. I don't want to go too overwhelming, but thanks so much for coming out. Number 97. So. Yeah. Yeah. Anything you want to take a picture
Just a
of?
school assignment. I have to do that.
What do you want to take a picture of? Oh, everyone
Just
in?
myself.
Just you? You want me to put cool stock charts in the background? So.
Yeah, I just take myself there.
Oh, yourself?
Yeah, it's fine. Yeah, I don't want to make you guys uncomfortable. Yeah.
Ready for the today?
Hi, thank you for the
yeah.
presentation. It's great. I have been out of practice. I was studying finance in college, but I have not been doing that as a profession.
Yeah.
But I'm just trying to, pick it up and then do it for my own benefit.
Right.
And then, do you have any kind of like I mean, things sound familiar, but I don't really know. Like, it's kind of hard because like a lot of I don't really follow.
Yeah. Yeah.
But anything I would appreciate you can give me some pointers, like for next time. I can read ahead of time. Like what website to look at and what information.
Yeah,
to look at.
I can show you the resources I use. I use
Okay.
FinViz to look at stocks.
Yeah, I copied that one, huh?
Yeah, finviz.com is what I use to look at stocks.
Okay.
But this is the paid version. I paid $300 a year, I think, for it. I
Oh, it's
forget the
paid
price.
version, okay.
Yeah.
Maybe start with non-paid version first, huh? For
Yeah,
me.
start with unpaid, and then when you feel more confident, then you could jump into paid.
Okay.
If you want fundamental analysis, probably I'd say use free. Like, go to, oh man, I don't even know why I use for free anymore. You could go to MarketWatch, they have something that's free.
Okay, that is like
MarketWatch.com is free for fundamental data.
Okay, sure.
But Yahoo Finance,
Yahoo Finance. Yeah,
Yahoo
yeah,
Finance, Reuters, yeah, Yahoo Finance is probably good for free for now.
Okay.
But most of my fundamental analysis I pay.
Okay.
So
Like which one do you pay for?
I pay for Guru Focus, but this
Guru
costs like
Focus, okay.
$850 a year.
Why so much?
It gives you 30 years of financial data.
Okay, I'm not there yet. So
Yeah, so
$800
I also read
okay.
SEC filings, which is the most honest. Hey, thanks so much.
SEC filing.
What was your name again? Nice to meet you, huh? Yeah, thanks so much for coming out.
SEC filing, okay.
Yeah, yeah.
That you can get that easily
Yeah.
through the FEC site, right? What about like brokerage firms like Charles Schwab and those? Those I have.
They're all the same. I use TradeStation because I like it,
Okay.
but they're all the same.
Okay.
Yeah, they're just a broker. They don't determine how good you are or how you succeed.
Oh, I don't care. Just
Day trading, I probably use TradeStation, Interactive Brokers, or
I'm a stock trader, beginner, so novice. So I make over the limits. And I track
then you can use options.
25,000 back, and I made day trading, and I got banned by the
Because
pattern
day trading.
So in this case, I cannot do any investment.
Yeah.
How about the investment I previously invested in Wales Farm? I don't know if you know the app. They're just
So what you can do is open multiple accounts and then you can trade.
Can I?
If you do multiple accounts.
Can I?
Yeah. Yeah.
So it doesn't matter for one person.
Only the broker will regulate you. So you use like 5 brokers, and then you have 15 trades.
Thank you.
Yeah.
That's
It's like a around the corner type of technique.
but it doesn't influence my tech report.
I don't know.
Okay.
No. Hey guys online, I'm gonna clock out. Just want to say thanks so much for coming out. We'll catch up next week. There's a lot of people in the room, so I gotta talk to people. Okay, see you guys. Welcome, welcome. Okay. Oh, hey.
Make another question.
Yeah.
So I have a class still, another class that wanted us to make a final assignment for two companies to compare. So we pick one in the end. I think you know must know about how do I make finish this assignment by looking at what kind of component of stock.
Well, how to analyze a stock?
Yes.
Easy.
Easy.
Yeah. Yeah. I mean, which one you want to do? Chart or fundamental? Chart analysis or fundamental analysis?
What's the difference?
Chart is like the stock chart. Fundamental is financials.
Ratios.
Financials?
Yeah.
Well, I would start by looking at how big the company is, market cap.
How about we compare Alibaba with Amazon?
With
or Walmart with Amazon? Like,
Walmart and Amazon compare. Like which one's better or which one?
yeah, kind of like that.
They're dependent. Probably Amazon, but Walmart has a huge existing
I
operation.
understand, but how do we analysis for comparing? What kind of components? It seems that for one stock we will have several categories and with a bunch of ratios in one category. And I have my textbook and those things. And how do we extract the most important things out from to compare this?
There's no most important. They're all important, and they're all different for each stock. Like software stocks don't have inventory.
Yes.
But
yes,
industrials have inventory.
But Walmart has inventory. That's
Yeah,
the problem.
you see what I mean? So each analysis is different. You have to piece it out by sector and industry. So if you do a sector analysis, then do two tech stocks. Two tech stocks, what industry? You can't do memory and data center, or you can't do memory and software. You got.
But these days there are so many things.
Hey, how's it going, man?
I like your meetup.
Yeah.
And I was a consumer for a long time.
You were a consumer for a long time. Well,
I mean, I kind of.
Yeah.
If you need something, I can contribute.
Yeah,
Just
man.
tell
Yeah.
me what you want
Yeah.
to do. If you need any help, really.
Yeah, David. Thanks, man. I appreciate it. I'm just trying to grow the community, and wherever it goes next, I'll think of you guys for help. Yeah. What was your name again? I didn't catch your name.
My name is Gang, G-A-N-G, Gang.
Nice to meet you, man. Feel free to reach out to me on Meetup if you want to contact me. Yeah.
We put a lot of effort into this.
Yeah.
How many members do you have right now?
1,000. 1,000 across 3 meetups. Yeah.
I don't know how do you want to take it to the next level?
I plan to, but
What would be next level for you?
next level is so I'm building out my real estate business. So when the deals start coming in, I quit my day job and then I focus on that, and then I run more meetups. And I'm going to run real estate meetups and stock market meetups. So meet more real estate investors, and between those two networks, if I find more deals, then I could share with the investors at the club. So we source more deals, put a fee in between, and that's where everyone benefits. But at the same time, I can't operate intelligently if I don't have a grasp of like global macro, what's going on in the world. So now I know what's going on in the world. I'm more confident when I go out and talk to people, because I know most people, I'd say 99% of people are just mindless consumers, and then like maybe a portion is like half consumer and producer. Well, I want to be like more close to like 100% producers, people who just produce value.
Do you plan to move into kind of money management?
Yeah.
Because for this
Yeah.
you need to get certain certification. You
Yeah,
need to
I have it already.
Okay.
Yeah. Series 766. Yeah. But that probably won't be till later. Yeah. So you could easily start a fund.
Easily, I wouldn't say easily, but yes.
With money, you can start a fund. But my fund would be, it wouldn't be a RIA, if you know what that is, Registered Investment Advisor. It'd be a ERA, Exempt Registered Advisor. So a VC fund is an ERA. A private equity fund is an ERA. A real estate fund is an ERA. They're exempt from certain regulations that maybe wealth managers don't have access to. So I'm only going to focus on like, if I raise a fund, a niche group of investors. Yeah, but right now I'm focusing on networking with other local VCs or whatever type of investors, and then also working the deals on my own.
Would you be interested in something like investment club?
Yeah, this
Which
right here.
is, no, it is not investment club. Investment club means that we kind of chip in for some resources
Oh.
and we run kind of model portfolio and we vote, whatever, we make decisions about this portfolio. That might be interesting, that
Yeah,
might bring
yeah.
some people. And there's good software with tax hassle and everything, this software can take care of, and cost of this is really small.
Yeah, I mean, we'll see. This has been, I completed about 2 years now of this. Yeah. Number 100 will be 2 years. Huh?
You put a lot.
Yeah, I know. The mixers are valuable too because so many people of different value come in for different consumption patterns, you know? So, like, I could buy a cafe and send them to my cafe. And then that's like ways to make more money, but I probably won't do that. I'll see where it goes. Because I also follow up and call people and see, you know, what are they looking for and try to establish like a B2B partner channel. And yeah, kind of just keep going. I never thought I would get into real estate, to be honest. I just started an investment club, and then it just evolved because the analysis evolved. So we'll keep pushing and see where it goes.
Well, again, if I can be useful to you,
Yeah,
I don't
man.
need anything in return.
Yeah, I have your contact on Meetup, right? Yeah, I'll reach out. I mean, do you have any, ventures or ambitions at this time, or? No?
Actually, I have different kind of, I'm at different stage of my life.
Yeah,
so what
exactly.
I started to do lately,
Yeah.
I meet one-on-one with my friends or people I know who need some financial help.
Yeah.
And I usually help them to put together a portfolio, and I do everything right, not like I did for myself.
Right.
But I learned a lot of lessons.
Yeah.
And usually, it's kind of very simple. It's not exactly financial planning, but like advanced financial planning. And let's say for your age, kind of I met recently with a guy, and I explained to him, you know what? You're at this age, just forget about stock market. You will never make a quick buck. You might, but your chances is less than 1%. Forget about it.
Yeah.
Just try to do startup. Try to choose between startup and career in the corporation.
Yeah.
Do dollar average, and I can help you with portfolio composition.
Yeah.
Just do dollar average with the portfolio, and 20 years from now, you will be rich and prosperous, no matter what you do in your startup or your career.
Yeah. So I think I'm transitioning directly first into the real estate market and just get the transaction fees because of high value assets, right? So get those, and then I only need 5 deals a year to be stable. But I want to build up if people know you, it comes in automatically. So build that up, and then I have a lot of trading capital. But I might not do that. I might just go maybe develop homes on one project, and then once I master that, I'll go do multifamily or whatever. And then now you have like a huge income stream. I'll invest in dividend stocks, now you got more. Well, shoot, I don't know. Now I'll jump into venture capital. Who knows, right? But I think I want to, for now, just chase those high value deals because it pays out the quickest, right? Every deal is like 10 to 20K.
Let me ask you, I recently noticed a few meetups and people who put meetups like a meeting with mega multi-units, mega syndicate or something.
Yeah, I go to those.
What are these? What do they do?
They're looking for investors too.
So basically they just try to make business on other people's bucks. That's my understanding. Okay. Everything else.
I mean, at the end of the day, everyone's trying to make business on people. Like, even me, right? But I do it in like a more honest, my style of business is more honest than some people.
You can choose. So when you need to do business, you can derive your income from other people, money, but you need to convince them. And you can actually die trying to make it right. And a lot of people actually do. They never succeed.
So I guess, with my deal sourcing expertise, I could cold call and raise money. Then I raise money, but I have to find investments. So now I want to improve on my investment game. So to me, it's, that's what they taught you at Morgan Stanley. Pick up the phone, call for the money.
Yeah, you're a very fine young man.
Yeah.
So what will it take you to start adding gold to your portfolio?
Sorry, what? Say again?
Adding gold to your portfolio.
Adding gold?
Adding gold, yeah.
What would start?
what will make you to add gold to your portfolio? You have something now, I understand.
Yeah.
But again, we all have something now, and
Yeah.
that's why gold is kind of nowhere.
Yeah, yeah.
We need people to start adding more.
Right. What would make me add more? More further downside in the indices around the world, not just the S&P 500. I want to see. I'm already seeing downside in European markets. But
Safe haven.
yeah, I want people to be so scared they're gonna run to safe haven. So, but I think they'll run to the U.S. dollar first, and then gold is secondary. It's only when they run to the U.S. dollar and central banks feel the dollar value is too high, it's too much pressure on the world, they will devalue the dollar down, and that's when they'll run to gold.
So you will not think about big bet on gold. Big bet, I mean like
Not until the chart confirms it. I don't see confirmation yet. It's still going sideways. But I see some accumulation over a period of 5 years.
I think some people are making big bets right now.
I think so too.
Because once
Yeah. So that's where I'm kind of sitting. So hey, we'll keep monitoring, man. To me it's fun. I took 2 weeks off. I had nothing else to do.
Yeah.
So I cold call a lot more. So.
Thank you so much for this meetup.
Hey, David, you're welcome, man. If you want to find deals somehow, always room to work together. Man.
I'm not in real estate. I was unlucky with real estate. Every time I bought one, I got divorced and ended up on the streets. Real estate is not my thing.
Yeah. Well, hey, man. Well, we'll figure it out. Good luck. Thanks, man. Thanks.
Oh, yeah, options. Oh, yeah, no, I bought yeah, and I took like a $1,200 shower. Dude, yeah. And then I went to work and I just watched it go all the way down. I ended up $100 profit, and it took me totally profit. That was when I was like,
All right, guys. I was supposed to clock out, but got caught up in the conversation. Feel free to email me if you need anything. I'm gonna shut off. Thanks so much.